Welcome to The Winner's Voice. Today, we continue with the final part of The Value of Money by B.M. Anderson. In this final section, we complete the journey and uncover the last key ideas of this powerful book. Let's begin. Chapter 24. Credit, Bank Assets and Bank Reserves. In traditional discussions of banking, the impression is given that commercial paper is the normal and dominant type of banking assets. To one accustomed to this view, the figures of the Comptroller of the Currency for banking investments in the United States for 22,491 banks of all kinds, state, national, private, and savings banks and trust companies, in 1909, will occasion dismay. 000 omitted. Loans on real estate $2,505. Loans on other collateral security $3,975. Other loans and discounts $4,821. Overdrafts 69. United States bonds 792. State, county, and municipal bonds 1,091. Railroad bonds and stocks 1,560. Bonds of other public service corporations 466. Other stocks, bonds, etc. 703. Due from other banks and bankers 2,562. Real estate, furniture, etc. 544. Checks and other cash items 437. Cash on hand 1,452. Other resources 111. Total resources $21,095. These figures, however, call for further analysis. They include figures from institutions which should not be counted with commercial banks. The percentage of real estate loans, especially, is too high to represent the workings of commercial banks, a very high percentage of real estate loans being held by stock and mutual savings banks. The other items, however, are not much changed by the inclusion of savings banks and private banks. It will be well to draw some conclusions from these aggregate figures for all classes of institutions, before taking up a more detailed analysis of state and national banks and trust companies. Where, among these items, does one find commercial paper? In the reports of the metropolitan papers, giving daily variations in interest rates, it is usual to find commercial paper listed as a separate category, coordinate with 60-day paper, 90-day paper, etc. Recent periodical discussion has gone elaborately into the question as to what should be called commercial paper from the standpoint of the policy of the Federal Reserve banks. I think it's safe to say that no two markets, at present, in the United States will use the term in precisely the same way, and that all would restrict the term to a small portion of the other loans and discounts listed above. The most general definition of commercial paper would be paper bought through note brokers. Despite the decided increase in loans and discounts which our war prosperity has involved, there has been very frequent complaint of the scarcity of commercial paper. I shall use the term commercial paper in a much more liberal sense than the American money market does, and shall mean by it all loans of a really liquid character made by banks to merchants and others to pay for the purchase of goods in anticipation of a resale within the term of the loan which will enable the loan to be repaid at maturity. From this should be excluded, however, loans made to speculators. With this liberal, and not very precise, definition of commercial paper, we raise again the question as to where it may be found in the items above given. Virtually all of it, I think, must be found in the item Other Loans and Discounts, an item which, in all, is slightly less than 23% of total banking assets. But not all of this other loans and discounts is commercial paper. Very much indeed represents loans of a non-liquid character, regularly renewed, which manufacturers and others have put, not into movable goods, but into fixed forms of capital goods, as machinery and even buildings. One case in New York, which the writer is informed by a businessman well acquainted with both banking and business in many sections of the country, is typical of many cases, is as follows. A New York bank is at present lending to a small manufacturer of automobile supplies about $30,000. Of this, about $10,000 is liquid, periodically covered by bills receivable, and if the bills receivable should fail, in the period in question, to cover the $10,000, the bank would insist on a reduction of the loan. The remaining $20,000, however, is not liquid. It was spent for non-movable equipment. The bank expects to renew the notes for this loan periodically, and is well aware that it could not force collection without bringing the business to a close, or else forcing the factory to get accommodation elsewhere. The $10,000 that is liquid is by no means all spent for goods, but is spent, in part, for wages. None of the $10,000 is spent for goods which are to be resold without being transformed by manufacture. None of the $30,000, therefore, is, in the strict sense, commercial paper. It is manufacturer's paper. Part of it is virtually as liquid as commercial paper. 2/3 of it is not liquid. A very large part, indeed, of bank loans are of this character. A large part of the loans made to farmers are in no sense liquid. When the loan is made, for, say, 6 months, it is perfectly understood by both bank and borrower that a renewal will be asked for and granted. It is impossible to say what fraction of this $4,821,000,000 of other loans and discounts is really liquid commercial paper, or liquid paper of any kind, in the sense that it can be automatically paid off at maturity. I venture the statement with entire confidence, however, that the proportion of liquid paper is not 1/2 of the amount. I should question if more than 1/4 of it is truly liquid, in the sense in which that term is commonly used, meaning that the loan is made to put through a transaction which will be completed during the term of the loan, and permit the loan automatically to be paid off. I do not mean by this merely that the banks could not reduce this item by 1/4 suddenly. Even in a market made up wholly of highly liquid paper, an arbitrary refusal to renew 1/4 of the loans, with the effort to reduce loans and discounts by 1/4, would occasion great embarrassment and even disaster. The test of liquidity here applied relates to the items separately, on the assumption that other things are not radically changed. Even in this sense, however, viewing each loan transaction separately, it may well be questioned if the banks in the United States could find among their other loans and discounts items exceeding 1/4 of the total, in value, which they could refuse to renew, at least in large part, without disappointing reasonable expectations and embarrassing good businessmen. Of this paper, not truly liquid, no doubt a good deal is advanced to wholesale and retail merchants, and is, in this sense, commercial paper. The terms liquid paper and commercial paper by no means run on all fours. As will later appear, the bulk of liquid banking assets are not commercial paper at all, and only that part of a bank's loans to a merchant may be called liquid, which can be paid off by the merchant without disappointing his reasonable expectations, causing him to seek other banking connections. There is, however, another item in which we may find some commercial paper, and this is the item, loans on other collateral security. This has commonly been supposed to be virtually all stock exchange loans. Thus, Conant cites the growth in this item in New York as evidence of the growth of loans on stocks and bonds. For New York, loans on stocks and bonds do make up the great bulk of this item. Even in New York, however, there are other factors in it, absolutely, even though not relatively, important, and in the country outside, the other elements are not at all negligible, even though for the outside country the part secured by stocks and bonds is the major part, and even though the growth of this item in our total banking assets is, in general, fairly indicative of the growth of loans secured by stocks and bonds. Figures for the other items are not available for state banks, trust companies, or savings and private banks. They are not till very recently available for national banks. In 1915, however, the comptroller separates the item, loans on other collateral security, for national banks, into two parts: 1. Loans, secured by stocks and bonds, $1,750,597,273, and 2. Loans, secured by other personal securities, including merchandise, warehouse receipts, etc. $882,749,812. Is there any commercial paper in this last, not inconsiderable, item? Let us locate the item, in the effort to find out. The percentage runs highest in Chicago, where this class of collateral loan exceeds the loans on stocks and bonds. The inference is strongly suggested, therefore, that much of it, there, at least, represents advances to livestock, grain and produce traders and speculators on the Board of Trade, at the stockyards, etc. The inference is strengthened by the fact that St. Louis, where there is a good deal of grain and commodity speculation, shows more than twice as much of this kind of paper as does Boston, where this kind of speculation is unimportant, despite the fact that Boston's aggregate collateral loans of all kinds greatly exceed such loans in St. Louis. In New York, where there is a great deal of coffee and cotton speculation, and some other commodity speculation, the amount of this paper, though relatively small, is absolutely greater than in any other city. No doubt, in New York, which is the country's center for foreign commerce, a fair amount of the paper secured by other personal securities, including merchandise, warehouse receipts, etc., is really commercial paper, representing advances to importers and exporters, though the difficulties of giving this kind of security where goods are in transit would prevent most of our foreign trade being financed in this manner. The total of this kind of paper in New York, all these figures are for national banks alone, was only 113 millions on June 23, 1915. It may be doubted if very much of this paper, in the great cities, represents goods in transit. With the caution that the view here expressed is based on inference, and not on actual knowledge of what the large city banks are doing, the writer concludes that probably the bulk of this paper, in large cities, represents loans to speculators rather than to merchants. It is liquid, but it is not commercial paper. What of such paper in the country districts? Nearly one-half, $436 million out of $882 million of these national bank loans on other personal security, including merchandise, warehouse receipts, etc., are in the country, outside the reserve and central reserve cities. Much of it is in the South. Much of it in the grain and livestock producing regions. What do such loans mean? Much of it is loans to farmers and planters. In the South, much of it is on crop liens. The loans on cotton warehouse receipts, at least in the country parts of the South, are not as great as is commonly supposed. In the North and West, there are a great mass of farmers' chattel mortgage loans, including loans on horses, grain in cribs, hogs, sheep, cattle, mules, etc. The use of this type of paper for financing the breeding and feeding of livestock, particularly hogs, cattle and sheep, is very extensive. Virtually all loans to farmers and feeders for these purposes are secured by such chattel mortgages. It seems improbable that a great deal of this paper could represent ordinary commerce. Neither wholesalers nor retailers can easily handle merchandise on which chattel mortgages have been given. The usual method of granting credit to them is to advance loans on 1 and 2 name paper, unsecured. Not many loans to retailers and wholesalers will fall in the category under discussion. To what extent are the loans of this type to farmers liquid? Well, the crop lien loans in the South have a natural term, and, though commonly longer loans than bankers have in mind when speaking of liquid paper, are liquid in the sense that they are automatically paid off at maturity. Loans on work animals need not have a natural term. Loans on animals being fed for the market have such a natural term, and are truly liquid. Loans, however, on breeding animals are not thus liquid. Such loans are commonly regularly renewed at maturity, and the banks do not count on them in emergencies. It is the opinion of Dr. J. E. Pope that fully 2/3 of the aggregate loans on livestock chattel mortgage security are to breeders rather than to feeders, and hence are not liquid. Of course, none of these loans are commercial paper. I conclude, therefore, that the thesis with which we started, that the overwhelming bulk of commercial paper is to be found in the item, other loans and discounts, is correct. I see no reason to suppose that an analysis of the loans of state banks and trust companies would show a different conclusion. We lack the figures for breaking up the collateral loans of state banks and trust companies into the two classes, secured by stocks and bonds, and secured by other personal securities, including warehouse receipts, merchandise, etc. We have merely the gross figures for collateral loans. As the state banks are in large degree country banks, it is probable that the percentage of commodity collateral as compared with stock exchange collateral for state banks would be larger than for national banks. However, the total of collateral loans for state banks is relatively small, 559 millions, for 1909, as against other loans and discounts for state banks in that year of 1,112 millions, and as against a total of collateral loans of all banks reporting in that year of 3,975 millions. On the other hand, the collateral loans of the trust companies are very large, 1,222 millions for 1909, as against other loans and discounts for the trust companies in the same year of 460 millions. As the trust companies are chiefly city institutions, and as the concentration of trust company loans and capital in New York City is relatively very great, it would seem pretty clear that taking both state banks and trust companies into account would substantially lessen the percentage of loans secured by other personal security, including merchandise, warehouse receipts, etc., to total collateral loans. As the amount of commercial paper in this class of loans for national banks is probably small, it may be expected to be still smaller in the aggregate of collateral loans. The following figures, for state and national banks and trust companies, only, will, in the light of the foregoing, give us basis for some further conclusions regarding the character of banking assets in the United States. As before, the year 1909 is chosen. 000 omitted. Resources: state banks, national banks, trust companies, aggregate. Real estate loans 414.57, 377, 848. collateral loans 559 1939 1222 3720. All other loans 1112 2966 464,538. U.S. bonds 5743 748. State, county and municipal bonds 65 156 155 376. Railway stocks and bonds 75 351 362 788. Bonds of other public service corporations 5148 168 366. Other bonds, stocks, etc. 95 208 769 1072. Total of items here listed 2,375 6,565 3,516 12,456. Total resources 3,338 9,368 4,068 16,774. This table makes clear that the figures for real estate loans given in the table for all banks, a few pages preceding, were much too high. It leaves the relations among the other items, however, not greatly changed. All other loans increase from slightly less than 23% of total assets to 27%. If we concede that one half of the all other loans represents liquid commercial paper, a very liberal estimate, as we have previously concluded, we get about 13.5% of the assets of these institutions in the form of commercial paper, an increase over the 11.5% to be assigned on the basis of the other table. The figure is the roughest sort of approximation. I attach little importance to the exact percentage, and the argument which follows is not dependent on any exact figure here. The proportion of collateral loans to total resources is changed also, and even more, collateral loans are 18% of total bank resources when all kinds of banks are included, and are over 22% of total bank resources when only state and national banks and trust companies are counted. If the foregoing is correct within very wide limits of error as to the amount of commercial paper, collateral loans very substantially exceed commercial paper. If all other loans should be counted as commercial paper, collateral loans are still not far behind them, 22% as against 27.5%. What is the significance of this? We have seen that for national banks, the great bulk, over 66%, of the collateral loans were secured by stocks and bonds in June 1915. We saw reasons for supposing that a higher percentage of stock exchange collateral would be found when state banks and trust companies are included. Suppose we assume that 75% of the collateral loans of all three classes of institutions here in question are based on stock exchange collateral. This would mean 16.5% of the total resources of these institutions in stock exchange loans, still well above the 13.5% we have assigned to commercial paper. In any case, it is at least justifiable to contend that loans on stock exchange collateral are as great in volume as commercial loans. I think that they very substantially exceed them. But further, we have another large percentage of bank resources invested in stock exchange securities outright, chiefly in bonds. The aggregate for those investments in the institutions under consideration is 3,250 millions. This is something over 19% of the total assets of these institutions. Combining this with the loans on stock exchange collateral, we get nearly 36% of bank and trust company assets invested, directly or indirectly, in stock exchange securities, as against an assumed 13.5% in commercial paper. Conceding that all other loans are commercial loans, the stock exchange assets still exceed them in the ratio of 36 to 27.5. In our second table, we have listed items which aggregate only 12,456 millions of the total resources for these institutions of 16,774 millions. The items listed, however, represent virtually all the credit extended by banks to industry, commerce, agriculture, the stock market, other speculation, and the state. The excluded items of main importance are due from other banks and bankers, 2,302 millions, checks and other cash items, 432 millions, and cash on hand, 1,411 millions, the three items aggregating 4,146 millions, which virtually closes the gap. These three items are of immense importance as making for liquidity in banking assets and as making possible extensions of credit to the business world, but it is not proper to count them when an estimate of the extent of bank credits is in question. Our second table contains, for the three classes of institutions, all the items properly counted there, except overdrafts, small in amount, and one other big item which does not get into bank statements at all, namely, overcertifications and morning loans. Of this last item, more later. We may, then, recalculate our percentages on the basis of the credit extended by the three classes of institutions, instead of on the basis of total resources. On this basis, the percentages are: real estate loans, 7.4%, collateral loans, 30%, of which we assign to stock exchange collateral, 22.5%, and to other collateral, 7.5%. All other loans, 36.4%, of which we assign to commercial paper, 18.2%. Total stocks and bonds, 26%. Adding the percentages for stock exchange collateral loans and for stocks and bonds owned, we get 48.5% of all extensions of bank credit for these three classes of institutions in the form of credits extended to the security market. If everything else except the real estate loans should be counted as commercial loans, the stock exchange credit would still exceed the commercial credit. If my estimate of 18.2% of bank credit based on commercial paper is high enough, the banks and trust companies have extended over 2.5 times as much credit at a given time to the security market as they have to commerce. This on the face of the record. But there is, as above indicated, a further item which does not get into the record, namely, overcertifications and morning loans. Every day in the great speculative centers, and very especially in Wall Street, enormous advances are made to brokers, which are cancelled during the day, but which, during their short life, are a real addition to bank credit. To attempt to estimate this with any accuracy is hopeless, but the total on any ordinary day is enormous, and most of it is extended in connection with stock market transactions. A final comparison, which will conclude this perhaps too wearisome analysis of these figures, will consider the loans alone, neglecting the securities owned. Of total loans, real estate loans, 9.3%, collateral loans, 40.8%, of which we assign to stock exchange collateral, 30.6%, and to other collateral, 10.2%. All other loans, 49.6%, of which we assign to commercial paper, 24.8%. The development of bank loans on stock exchange collateral is a remarkable feature of the 3 or 4 decades preceding 1909. The following figures, of national bank loans in New York City, illustrate the tendency. 000 omitted. Date loans on commercial paper advances on securities. 1886 146 107. 1890 151 145. 1892 160 183. 1894 168 192. 1896 151 162. 1898 181 260. 1900 185 384. 1902 210 396. 1903 239 391. 1904 268 538. The tendency is not peculiar to America, however. The following table gives a classification of the loans and discounts of all the great European banks in selected years from 1875 to 1903. Figures in francs, 000 omitted. Date note circulation commercial loans advances on securities. 1875 9,699 4,027 828. 1880 10,482 3,384 1,112. 1885 11,662 4,050 1,231. 1890 13,194 5,192 1,549. 1895 15,896 5,328 3,669. 1899 14,992 8,352 4,037. 1900 15,906 8,514 4,171. 1902 16,215 6,939 4,178. 1903 16,539 6,147 4,129. We conclude, therefore, that the great bulk of banking credit in the United States, even of commercial banks, is not commercial credit. Much of it, in the smaller places especially, represents in fact, whatever the form, long-time advances to agriculture and industry. Most of it, in the great cities, and to a large extent in even the smaller places, represents advances to the permanent financing of corporate industry. Excluding real estate loans, more than half of bank credit represents either ownership of bonds, with some stocks, or else advances on stocks and bonds. Another important part of bank credit, which I shall not even attempt to measure, is employed in financing commodity speculation. It is worthwhile to compare our figures concerning bank loans with Kinley's figures, which we have previously considered, for deposits made on March 16 of 1909, the year we have chosen for the bank loans figures. It is important to remember that deposits, as used by Kinley in this investigation, does not mean what the term means in a bank balance sheet. Kinley's figures relate to the actual items deposited on the day in question, and not to the net balance after deposits and withdrawals have been compared when the bank is closed for the day. A large deposit in the balance sheet sense might show no deposits in Kinley's sense in a given day, while enormous deposits in Kinley's sense might be so offset by incoming checks that virtually nothing is left on the balance sheet at the end of the day for a given depositor. Kinley's figures thus give us a means of getting at the degree of activity of different classes of deposits in the balance sheet sense, and so, indirectly, of different classes of loans. Loans and deposits, in the balance sheet sense, are, as we know, closely correlated. This is true for banks in the aggregate, and for banks individually at a moment of time. It is not generally true of a given individual deposit account at a moment of time, but through a period of time, for business deposits, it tends to be true that the items deposited offset the amounts borrowed. If the items deposited are numerous, if the depositor has an active deposit account, receiving a large flow of banking funds, as compared with his net deposit balances, we may infer that his loans are also active, that he pays off loans frequently, that his paper, in the assets of the bank, is liquid. I need not give the details of Kinley's figures again, as they have been elaborately analyzed in connection with the estimate of the volume of trade. The figures show that retail and wholesale deposits between them make up about 25% of the total deposits. This would serve to show that commercial paper, which we have allowed to be about 24.8% of total loans, is slightly more active, and hence liquid, than the average of loans. It will also suggest, however, that our figure for commercial paper, truly liquid, is too high, since we should expect this kind of paper to be more active than the average, unless, indeed, stock exchange collateral loans are so exceedingly active as to make a tremendously high average. I refrain from trying to get a definite answer on this point, since there are many indeterminate elements. Among others, uncertainty as to the extent to which wholesale deposits and retail deposits include all commercial deposits, and uncertainty as to the extent to which they exclude manufacturers' deposits. The great bulk of Kinley's deposits, however, fall into the all other class, and the great bulk of the all other deposits are located in the great financial and speculative centers, particularly New York. We have concluded that they represent chiefly a. transactions in securities, b. other speculation, c. loan and other financial transactions, particularly the shifting of call loans on stock exchange collateral. It is, then, the deposits of those connected with the great financial and speculative markets, particularly the stock market, whose deposits are most active, and whose loans are most liquid. Stock market collateral loans thus constitute the most perfectly satisfactory sort of bank loan from the standpoint of liquidity. Though such loans do not make up the bulk of bank loans, we have concluded that they constitute 30.6% of the loans of state and national banks and trust companies in 1909. They do account for the bulk of banking activity and supply the greatest part of the liquidity of total bank loans. When we consider further the item of securities, chiefly bonds, in banking assets, we find another highly important source of liquidity. The sales of bonds in the great banking centers are enormous. The figures of bond sales on the exchanges do not begin to tell the story. One big bank in New York in 1911 sold more than half as many bonds as were sold in that year on the floor of the stock exchange. It has been frequently stated that 10 bonds, of those listed on the exchange, are sold over the counter for one on the floor. This is truer of Boston than New York. The outside market for unlisted bonds is a very important matter. Dealings among banks in these items and in foreign exchange are exceedingly important. This is especially true of the business of the great private bankers, as Morgan, Kuhnloeb, and others. Much of this does not appear in Kinley's figures, since neither the deposits of the great private banks in other banks, nor the deposits made in the private banks themselves, so far as New York City is concerned, figure in his totals. Had they been included, the percentage of the all other deposits would have grown, and we should have had still more impressive evidence of the fact that modern banking in the United States is largely bound up with the security market, and that modern bank credit gets its liquidity chiefly from that source. The story is even more impressively told by the figures for bank clearings, which include the transactions between banks and the transactions of the private bankers. In New York, in 1909, total clearings for the year were 104 billions, as against 62 billions for the whole country outside New York. That bank clearings are closely correlated with stock exchange transactions has been demonstrated fully by N. J. Silberling, who has shown the following correlations. New York Stock Exchange share sales with New York clearings are equals 0.718. Total clearings for the country with New York share sales are equals 0.607. Total clearings for the country with railway gross receipts, as representative of ordinary trade, are equals 0.356. The active deposits and the liquid loans are chiefly connected with activities in finance and speculation. Now, two important practical conclusions are suggested by this analysis. The first is that the complaint of many farmers, merchants, politicians, and even scientific writers that too much money and bank credit are at the disposal of Wall Street and other speculators rests on a misunderstanding of causal relations. Wall Street does not, by using a large amount of bank credit, take just that much away from ordinary business. Rather, it increases the amount available for ordinary business. Wall Street and the other financial and speculative centers supply the liquidity for bank assets and so make possible loans on non-liquid paper. Banks do not need to have all their assets liquid. If they did, American banks would have long since gone under. The foregoing discussion of loans to farmers and manufacturers and even merchants should have made that clear. But banks do need a substantial margin of liquidity to protect the rest. They get it from stock exchange collateral loans and from ownership of listed and easily marketable bonds, primarily. They get part of it from true commercial paper. Thus, the director of a country bank in Iowa told the writer that banks in his section, where banks owned in large measure by farmers and dealing largely with farmers, are very numerous and important, make a regular practice of buying, through brokers, a considerable amount of notes of outside merchants. They do this to protect themselves. Their other loans, to farmers, while good, are slow. If pressed themselves, they cannot press their depositors. These notes bought through note brokers, however, are impersonal. They can refuse to renew them. They can sell them again. They thus buttress the rest of their assets. They can thus lend more, rather than less, to local customers. They can safely get along with much smaller cash reserves. Similarly, with the practice of country banks of sending a large part of their cash to Wall Street banks to be lent on call, for which the country banks get, say, 2% for the Wall Street banks. Their country customers would pay 6% or more for that money in some cases, but the banks dare not tie up more of their assets in non-liquid local paper. They lend more, rather than less, at home, because they send part away. Wall Street is not draining our commerce of its lifeblood. Wall Street is rather preventing that lifeblood from coagulating. A second important practical conclusion relates to the provision in the Federal Reserve Act which forbids Federal Reserve banks to rediscount stock exchange paper. This provision was intended to keep funds from being diverted from commerce to stock speculation, and doubtless met the approval of many very good students of the subject. If the foregoing be true, however, that provision is a mistake. It is a mistake, first, because it will lessen, rather than increase, the power of the reserve banks to provide relief to commerce through aiding in making bank assets liquid via the stock market. It will limit the liquid assets of the Federal Reserve banks in too great a degree to gold. It is a mistake, in the second place, because it prevents the reserve banks, particularly in New York and Boston, from making satisfactory profits, which is one important purpose of a bank. Even more important, however, is the third objection. It prevents, in large degree, the Federal Reserve banks from being effective weapons against the money trust. How far we have a money trust need not be here argued. The Pujo Committee, relying in considerable degree on admissions of prominent financiers that concentration had gone far enough, and on the inability of Mr. Baker to find more than one issue of securities of over $10 million within 10 years, without the cooperation or participation of one of the members of a small group, concluded that we have a money trust in the sense that there is an established and well-defined identity and community of interests between a few leaders of finance, which has resulted in a vast and growing concentration of control of money and credit in the hands of a comparatively few men. How far this conclusion is justified is, of course, a matter that would require elaborate discussion. There seems to be evidence that there is, since the death of the elder Morgan, a decided loosening of ties. One feels the need, moreover, of discounting very considerably many of the conclusions of the Pujo Committee. The present writer feels that the case has been made, however, that there has been, and probably continues, a much greater concentration of such control than is desirable. Whether or not there is at present such a money trust, it seems pretty clear that temporary, if not permanent, alignments may give effective monopoly control when the issue of very big blocks of securities is involved. For present purposes, however, it is enough to note that if there is, or should come to be, a money trust, it is a trust concerned with financing industry, through handling security issues, and not a trust in the granting of ordinary commercial credit. If, therefore, the Federal Reserve banks are to compete with it, and break its monopoly, they must do it by entering the market with funds for the financing of corporate industry. Power to rediscount commercial paper seems a feeble and hardly relevant weapon against a combination concerned with purchasing securities and making collateral loans. No doubt, this power is worth something. If an independent investment banker wishes to compete with a money trust in financing a new enterprise, he can go to his commercial banker and offer collateral security for a loan. If the commercial banker wishes to aid him, but is short of lending power, he may, if he has plenty of commercial paper available for rediscount it with the Federal Reserve Bank and so get the additional funds. But a New York bank or trust company, with the bulk of its assets in stock exchange investments, may well not have enough commercial paper eligible for rediscount, and the Federal Reserve Bank could help very much more effectively if it could take collateral loans directly. A fourth, and even more important objection to the restriction on stock exchange collateral loans for Federal Reserve banks relates to the power of these banks to aid in a crisis. Crises first hit the stock market. Financial panics are most acute there. The need for immediate and drastic relief is greatest there. If stock exchange loans lose their liquidity, what of the rest of bank loans? Power to lend on stock exchange collateral, in the hands of the Federal Reserve banks, may well prove, in crises, an essential, if we wish to make our system definitely panic-proof. And now for a vital theoretical conclusion from this lengthy analysis of bank loans. For the quantity theory and the equation of exchange, all exchanges stand on a par. If one exchange takes place, that lessens the money and credit available for another exchange. The more exchanges there are, the less money and credit there are per exchange, and the lower prices must be, as a consequence. Nothing could be more false. Exchanges are not on a par. Some classes of exchanges increase, rather than decrease the funds available for handling others. The activity of the speculative markets, making loans fluid, enormously increases the lending power of the banks for all purposes. Exchanges of securities, especially, instead of lowering prices, make it easier for prices to rise. The years of extraordinary stock sales have always been bull years. There have been big bear days, but never big bear years, in the record of New York Stock Exchange share sales. The selling and reselling of speculative goods of securities, and of notes and bills are especially important as making it easier for banks to expand loans. To list all manner of items, as Professor Fisher does, real estate, commodities, stocks, bonds, mortgages, private notes, time bills of exchange, rented real estate, rented commodities, hired workers, and count them all as actual sales, all part of the goods which make up the volume of trade, is to put the theory utterly beyond the pale. Seasonal calls on an inelastic money supply for actual cash to move crops and pay agricultural wages may make a real difference in the value of money. Scarcity of money of the right denominations for retail trade may give an agio to such money, but the money and credit used by speculators, bill brokers, dealers in foreign exchange, investment bankers, etc., increases, rather than decreases, the funds available for ordinary industry and commerce. I have made clear the distinction between the direct and indirect financing of industry by banks. Great banks in continental Europe often buy the stocks of new corporations, hold them permanently, put bank officers on the boards of directors, and supervise closely the operations of the companies. In America, while officers of commercial banks often are members of boards of directors of the companies which borrow heavily from the banks, the practice is to make short-time loans to such companies, in form, if not in fact, and to lend on their securities, rather than to buy them. Our banks own securities in enormous amount, but they are chiefly seasoned bonds, rather than stocks of new or even well-proved enterprises. It is commonly supposed, too, that collateral loans are chiefly or almost wholly made to speculators, who buy securities in the expectation of holding them only till investors take them off their hands, and that investors buy them, not with bank credit derived from loans, but with money or bank credit which they accumulate by saving out of current income. It is particularly true of the higher-grade securities, which savings banks and insurance companies can buy, that this is the case. The bank credit thus serves for temporary, rather than for permanent financing, to the extent that this is true. I think, however, that the extent to which bank credit serves for permanently financing industry is underrated. A good many investors have learned that the short-time money rates are, on the long-time average, lower than the yield on long-time securities. They have learned, too, that high-yield securities high in yield as compared with the long-time average of money rates, can be obtained which can safely be carried on margins of 30, 40 and 50 points, without danger that even such catastrophes as the slump in security prices at the outbreak of the war will wipe the margins out. The old distinction between investors and speculators, the former those who buy for the yield, and the latter those who buy for an anticipated rise in capital value, no longer corresponds to the distinction between those who buy outright and those who buy on a margin. The investor, buying a 6 or 7% preferred stock, carrying it on a 40-point margin, with money from his bank or broker at 4 or 5%, is making 6 or 7% on his own $40, and is making the difference between 6 or 7% and 4 or 5% on the $60 lent him by his banker or broker. He substantially increases his yield thereby, and his risks, if he chooses his stocks carefully and scatters them among a number of issues, are not great. For the banker or broker, such a loan is perfectly satisfactory. The margin of security is wider than that demanded on more speculative securities. Such a borrower will receive consideration when more speculative loans are being called or not renewed. The investor of this type is, in effect, engaging in a form of banking business. He is lending to the corporation funds which he has borrowed from others. He has put up his own capital for the same purpose that the bank uses its capital, to supply a margin of safety to those who have taken his short-term promises to pay. Like the bank, too, he converts rights to payments at a later date into rights to payment at an earlier date. He is one of the links in the chain whereby the wealth of low saleability employed in industry becomes distilled and refined till it enters the money market. His profits come in the difference in the yield as between more saleable and less saleable forms of rights. The extent of this practice cannot be stated, so far as any data to which the present writer has access are concerned. The writer has met the practice in a good many cases. One brokerage house, with whose operations the writer has considerable acquaintance, makes a practice of advising its more conservative customers to do this. A good many brokerage houses sell investment securities on the installment plan, which often means, in practice, that the initial margin put up by the investor is his only payment, and that the security is gradually paid for by letting the yield increase the margin. During the extremely easy money of the present war period, occasional reference has been made in the financial papers to the practice of buying even the highest grade bonds on this basis, the yield of the bonds being very substantially higher than the money rates, giving a comfortable profit to those who hold the bonds on a margin. That the practice is not wider spread is due primarily, probably, to the temperamental qualities required. The investor, proper, is commonly a very conservative person, who has an unreasoning distrust of speculation, and to whom the word margin necessarily suggests speculation. That buying a stock on a margin is the same sort of thing as buying the equity in a mortgaged farm does not occur to him. On the other hand, the man who knows the market well enough to be willing to deal on margins frequently is not content with the slow process of accumulation which comes from annual yields, and prefers to take larger chances in speculation on capital values. But there is an intermediate class who buy investment securities with narrow range of fluctuation in capital values for the sake of the yield, and who buy them on margins ample to enable them to sleep at night and to neglect the daily market reports. I think that there are indications that this class is growing larger and more important. Doubtless much more important than individual bankers of this sort, however, is the enormous number of houses dealing in securities, wholesalers and retailers, who find profit on their wares even while on their shelves, through the differential between the yield and the charge made by commercial banks on collateral loans. A very large percentage of collateral loans is made to institutions of this type. As this practice becomes more important, the result must be to widen the money market, to increase the proportion of banking capital that goes permanently into financing industry, and to reduce the difference in yield between short-time paper and long-time securities. In other words, to bring the money rates closer and closer to the long-time interest rates. This would have seemed very strange and weird to Adam Smith. It means, in effect, that the bulk of our banking credit is, directly or indirectly, financing our industry rather than our commerce. Adam Smith thought that a bank could safely lend to its customers only so much as they would otherwise keep by them in the form of money. Perhaps this notion, as growing out of some speculations regarding the general theory of money, should not be taken as the statement of Smith's practical attitude on the matter, but that practical attitude, as clearly expressed in the paragraph following, is that a bank can afford to lend only for mercantile operations that are carried through in a very moderate time, that the bank can afford to supply only the minor part of the circulating capital and no part of the fixed capital of a merchant or manufacturer, no part of his forge and smelting house, etc. Such loans lack the liquidity which the bank must insist upon. Only those persons who have withdrawn from active business and are content with the income upon their capital can afford to lend for such purposes. The theory is sound, on the basis of the facts as Smith knew them. But modern corporate organization and modern stock markets have changed all that. Anything that is highly saleable can come into the money market, and the modern corporation organization of business, coupled with organized stock exchanges and a large and active body of speculators, has made the forge and the smelting house as saleable as the finished product. This is not to accept Schumpeter's doctrine, so far as the United States are concerned, that it is primarily the bankers, the manufacturers of bank credit, who make the decisions that turn industry from old to new lines. They do not, on the whole. In continental Europe, particularly Germany, they do to a much greater extent. Criticism has been made of our American commercial bankers, as contrasted with German bankers, that the former are parasites, who insist on sure things, and refuse to take chances with other businessmen in the development of industry. To the present writer, our banking system seems to be rather a more developed system than that of Germany, in that the division of labor has gone further with us, and risk-bearing and the manufacturing of bank credit have been more sharply differentiated. We have bankers enough who are risk-bearers. But they are, on the whole, private bankers, investment bankers, and the like, who do not manufacture a great deal of deposit credit, but rather borrow heavily from the commercial banks, which are the great manufacturers of bank credit. Under our system, the decisions which divert industry from old to new lines are more democratically made, by speculators and investors under the leadership of private bankers, and sometimes without that leadership. These constitute the important intermediary which transforms stock exchange securities into the basis of bank loans. The commercial banker buys, in general, not the stocks, but the note of the private banker, broker, speculator, or investor, with the stocks as collateral. If investment bankers, speculators, and investors decide to support old ways of doing things, the banks lend on the securities of the old kinds of businesses. If investment bankers, speculators, and investors turn to new things, the commercial banks follow suit. Commercial banks can and do discourage certain types of enterprises by refusing loans with their securities as collateral, or by requiring very heavy margins with such loans, but even these may be developed, and are with us on a large scale developed, on banking credit, advanced by the speculators and private bankers who borrowed it from the commercial banks with other securities as collateral. The commercial banks of the United States may to a very considerable degree check dynamic tendencies, but in general, they do not lead and direct them. Bank credit, directed by others than commercial bankers, does, however, enormously facilitate both the starting of new enterprises and social readjustment to them. How far can the total wealth of the country, agricultural as well as industrial, be brought into the circle of the money market? The full answer to the question would go far beyond the limits of this book. If agriculture can be brought under the control of large corporations, there is little reason for supposing that it, too, might not come in. There are some peculiarities of agriculture, special dangers of drought and flood, dangers of overproduction and low prices, wide seasonal fluctuations in conditions, which make it hard to standardize in any case. But mining and even the manufacturing of such things as primary steel products have wide variations in prosperity too. So long, however, as agriculture remains a matter of families on a homestead, and for social and political reasons, we may hope that this will always be the case, it is difficult to bring it in. Bonds of agricultural associations or of agricultural banks have had limited sale on the bourses of Europe. The present writer, for example, found it impossible to find in 4 great libraries in New York and Boston any quotation of the bonds of the Bayerische Landwirtschaftsbank. Apparently, in general, such securities have not high saleability. While this remains true, agriculture may expect to remain under a handicap of higher interest rates than industry and commerce. If, however, all forms of wealth could be made equally saleable, we should find interest rates rising for those loans and securities which now have the highest saleability. They would lose the peculiarity which now enables them to perform a service as bearer of options. money rates and long-time rates of interest would tend to come together. Long-time rates on formerly unsaleable loans would fall, and rates on highly saleable loans would rise. The present low rates in the money market grow out of differential advantages. We turn now to the third important aspect of the technique of banking, namely, the matter of cash reserves. First, I would point out that this is merely a part of the more general problem of liquid assets. The difference between cash and liquid paper is a matter of degree. There is large possibility of substitution of the one for the other, as it becomes more profitable to use one or the other. When money rates are low, it may well be worthwhile to carry large reserves. When money rates are higher, the gains to be made by substituting paper for cash in the bank's assets are much greater. I have pointed out the use which great European banks, notably the Austro-Hungarian Bank, make of foreign bills of exchange as reserve, selling bills when money is easy, and the yield on bills is small, buying bills when money is tight, and the yield on bills is large. The great joint stock banks of England, the chief sources of bank credit in the great banking country of the world, also make use chiefly of deposits with the Bank of England as their reserves. Some cash they keep, but it is till money rather than reserve. They carry, also, secondary reserves in highly liquid paper, stock exchange loans, and commercial bills. The differences are differences in degree. The Bank of England does keep a large reserve in cash, including notes of the issue department and gold bullion, but it denies that it has any definite ratio in mind, and it protects its reserves, when they are low, not by ceasing to loan, but by raising its discount rate. The whole thing is highly flexible. This is, in general, true throughout the world, where banking is highly developed. A country which has expanding business, based on rising values of goods and rising capital values of anticipated incomes, which in turn grow out of increasing business confidence, etc., and out of the development of new enterprises which make readjustment necessary, expands its bank credit to meet the situation. Expanding bank credits in time grow so large that bankers feel larger cash reserves to be desirable. Their reserves may be also, in some measure, drawn upon by the growing retail trade and wage payments, which call for more money in circulation. They meet the situation by raising money rates. This tends to prevent the exportation of gold, and tends to encourage the importation of gold, which finds its way into bank reserves. Banks may even borrow directly from banks in other countries, to get the gold they need, or to prevent the exportation of the gold they have. The higher money rates, also, tend to check marginal borrowing, the borrowing by those who see only very small profits to be made by the use of the bank credit they borrow. If the rising values of goods, however, and the profits to be made by affecting exchanges, speculative and other, are large, the volume of bank credit will, nonetheless, grow. If the tide of rising business confidence is strong, the banks will be disposed to accept securities and rights as collateral which they would distrust at other times. A very big difference indeed may appear between bank reserves in active times and bank reserves in dull times. The banks need less reserves in proportion to deposits in active times, because the very activity itself increases the liquidity, the saleability, of their paper assets, and so makes actual cash less necessary. Even in this country, the practice of counting deposits in other banks as reserve is well developed. This is not only true of country banks, or banks outside the reserve cities. It has been, in considerable degree, the practice of the big trust companies in New York City. It is the practice of private bankers connected with the stock exchanges, and the practice of brokers, who are, for many purposes, bankers, especially those who allow their customers to check on their accounts. Such houses may carry no cash at all. One, with whose workings the writer is somewhat familiar, makes the rule, "We pay by check and receive only checks." Nonetheless, this house allows its customers to check upon it, and checks drawn on it perform all the functions of checks drawn on banks which keep a cash reserve. Of course, our new Federal Reserve System is built, in part, on the principle of collecting reserves in central reservoirs, and our banks will doubtless increase the practice of counting deposits with other banks as reserve. They will feel the need for less reserves, also, with a wider rediscount market. Within a given country, I think that we may safely generalize the doctrine that the causal relation between reserves and deposits is exactly the reverse of that asserted by the quantity theory, within very wide limits indeed. That is to say, increasing reserves are a result, and not a cause, of increasing loans and deposits. We shall further hold that the relation between them, instead of being definite, is highly flexible. This is not to assert that reserves may not increase without a prior increase in loans and deposits. That has happened in the United States during the present war. It does mean, however, that increasing loans and deposits will pull gold into a country, and that increasing reserves do not force increasing deposits and loans if a country's business is growing, if that business is soundly based, so that expectations are being met, obligations being paid out of the income which arrives, on schedule time, to meet anticipations. There need be no effective check to the amount of gold that will come into the country to serve as reserves, within limits that are rarely reached. It is miscalculation, maladjustment of costs and prices in particular enterprises, failure of interstitial adjustments, especially failure of particular crucial links in the business chain, as the businesses engaged in producing iron and steel, to respond to the needs of other expanding businesses, that check movements of expansion in business, not inadequacies of bank reserves. As long as only wise plans are made, as long as they meet no mishaps, as long as the carrying out of the new plans does not itself so change the facts on which the calculations of businessmen have been based as to cut under anticipated profits, so long may business, within a given country, expand without danger from inadequate reserves. Of course, if the whole world is simultaneously expanding, the competition for gold in the international money markets may be so severe that all may be hampered. That reserves will increase, as expanding credit, due to increasing business or rising prices, requires increased reserves, can hardly be disputed, I think, if we look at a country of small size, or, what is the same thing from the angle of economic analysis, so far as the present problem is concerned, if we take a particular part of a country. Seasonal movements of cash for reserves in this country have been obviously determined by the movements of credit, rather than the reverse. Expanding business at crop moving seasons, requiring advances of credit by country banks, and an unusual drain on the cash resources of the country banks, has regularly meant that the country banks draw cash from the New York banks. When the need for such cash in the country banks passes, when they can no longer employ it to advantage at home, they send it back to New York. New York, to meet the emergency caused by the withdrawal of cash, draws to a considerable extent on Europe for gold. It is not as easy for New York to get gold quickly from Europe as it is for France to get gold in an emergency from England. More time is required. Inelasticity, too, in the forms of currency most needed for small transactions, has made very real difficulties for us. But that, within the country, the sections whose business and credit were expanding take cash reserves from those sections where credit is less urgently demanded, needs no debating. This is seasonal. But the same thing is true in the long run. As business and bank credit have expanded, year by year, in Oklahoma, Oklahoma's cash reserves have grown. Bank credit in a country cannot go on indefinitely mounting if bankers are making unsound loans, if the values on which the loans rest are based on vain imaginings, if anticipated profits are not realized. But if a country have rich resources and intelligent entrepreneurs, with sagacious bankers who can discriminate between sound and unsound business, it may, within very wide limits indeed, expand its bank credit without check from inadequate reserves, as its business expands, and as prices, particularly prices of lands and securities, rise. If the country in question be a very large country, however, large in the sense that its business and volume of bank credit are very large, and particularly in the sense that bankers' assets are of such character that a large volume of reserves is desirable, restraints on the process of expansion may come. Reserves will come in, but the resistance in stiffer money rates will be felt. Bankers in other countries will compete with the bankers in the country in question for reserves. Rising money rates will put an end to many marginal exchanges. They will lessen the saleability of many rights which might otherwise be available as banking collateral. The extension of bank credit will feel a drag. There is large flexibility here. But, in a long-run period of many years, the volume of gold in the world will impose a maximum limit upon the possibility of expansion of bank credit in the world as a whole. This limit is doubtless never reached. Within the limit, the variations in the volume of the world's credit are primarily determined by the other concrete factors we have been discussing. Proportionality between the world's gold and the world's volume of credit does not at all obtain. Under certain conditions, much higher proportions of reserves to bank credit will be found in a given country than at other times, and the same will be true in the world at large. I would refer again to the discussion by J. M. Keynes, quoted in Part 2. Reserves have absorbed enormous quantities of gold, easily obtained as a consequence of abundant gold production in the past 15 years. Proportions of gold reserves to bank credit have grown. In the preceding period, when gold production went on less rapidly than business development, percentages of reserves were lower. Most bankers feel better with large reserves. When they can get gold, they prefer gold to other substitutes. When they cannot easily get gold, they use other substitutes, of the various kinds of paper, particularly, which have been described. Gold differs from other things, in bankers' assets, in degree, rather than in kind. Instead, therefore, of the law of the proportionality of reserves to volume of bank credit, I venture the generalization that, as gold production increases rapidly, the tendency is for the proportion of gold reserves to volume of bank credit to rise. With diminished gold production, the tendency is for the proportion of reserves to fall, assuming that the factors other than volume of gold production which make for expansion of business maintain themselves. Increasing volume of gold tends to increase the volume of trade. But there are other causes for the increase or decrease of trade as well. These causes, working in harmony with rapidly expanding volume of gold, lead to a very rapid growth of trade. Working in the face of a drag from less rapidly growing gold supply, they strain the possibilities of bank credit expansion. Various substitutes for gold in bank reserves are employed. Substitutes in the form of other forms of credit are employed. Barter is resorted to increasingly. Methods of employing other things than gold in the retail trade of a country are resorted to. Gold exchange standards are devised. Countries wait their turns to come on the gold standard. Cooperation, not only within countries, but among countries, seeks to economize the scanty stock of the precious metal. Very large slack is thus revealed. But the expansion of business is checked, the volume of business confidence is reduced, the values of future incomes in enterprises is lowered, production is checked, and prices are reduced, A, because the value of money rises, and B, because the values of goods and income bearers is reduced. The exchange side of production is hampered. Substitutes for gold, through increased activities of bankers and other agents of exchange, are costly. Greater tolls on values are taken by those who handle the mechanism of exchange. It does make a difference whether or not the world's gold is abundant. But the difference is not made solely, or even mainly, in the price level. The reserve function of money is essentially a dynamic function. The reserve function is merely a phase of the bearer of options function. It is the practice of quantity theorists to speak of normal ratios between reserves and deposits, or reserves and demand liabilities, and to speak of the static laws governing this relation. This is true of Kemmerer, of Fisher, of A. P. Andrew, and, in general, of contemporary quantity theorists. Kemmerer very explicitly puts it as a matter of static theory: if we divide the money of the country into two parts, one that used directly in daily cash transactions, and the other that kept in banks as reserves, it may be said that, under perfectly static conditions italics mine, the proportion of the total represented by each of these parts would be constant. Each banker would find from experience what proportion of reserve to liabilities it was advisable for him to maintain, and would order his business, as far as possible, so that his reserve would neither exceed nor fall below that most desirable proportion. Kemmerer quotes the following passage from A. P. Andrew: in the long run, as apart from cyclic oscillations, the quantity of bank credit is governed by the quantity of money. Fisher's view we have considered at length in Part 2. It is essentially the same. He is working with the statics of the problem of money and credit. These different writers differ greatly in the extent to which they would insist on the validity of their static tendency in real life. Professor Fisher, as we have seen, is exceedingly uncompromising, holding tenaciously to his principle as subject only to slight modification during transition periods. Professor Kemmerer, in the chapter from which the quotation just given is taken, gives an important realistic analysis of dynamic conditions and makes liberal concessions to the view that the ratio is no constant in real life. Professor Taussig, whose view was summarized at length in Chapter 9, finds, in real life, so many exceptions to the doctrine of proportionality of reserves and deposits that he virtually abandons that doctrine. What I wish to insist on here, however, is that there are no static laws possible in this connection. The reserve function is a dynamic function. The theory of reserves must rest in an analysis of friction, of transitions, of dynamic uncertainty and dynamic change. It is a part of the general theory of liquidity of bank assets, of saleability of rights, and the like. If one can find a normal amount of dynamic change, a normal amount of uncertainty, a norm for the coming of technical inventions, a normal prospect of war, a normal rate of gold production, a normal rate of growth for population, a normal amount of Jew baiting in Russia, with a norm for migration, and if one can hold these norms, and a multitude of similar norms, in fixed relation to one another, one might have justification for speaking of a normal ratio of bank reserves to bank demand. Liabilities. Apart from dynamic changes, from frictional elements which create uncertainties, in general, apart from uncertainty and irregularity and lack of normality, there would be no occasion for bank reserves at all. To the extent that static conditions are realized, bank cash reserves may be, and are, dispensed with. It is well known that England gets along with surprisingly little gold. The total stock in the country has been smaller than the gold reserve of the Banque de France, and much of the gold in England was in use among the people, since small paper money, before the war, was not in use in England. The gold reserve of the Bank of England has been usually only a fraction of that of the Banque de France. Some years since, the distribution of gold as between England and the United States was, roughly, England $600 million, the United States $1,600 million. A larger proportion of gold was in reserves in the United States than in England. Yet England was doing the banking business of the world, while we had trouble in doing our own. The Bank of England carries virtually the only reserve in the country. The joint stock banks, with demand liabilities vastly in excess of the demand liabilities of the Bank of England, carry only till money in cash or Bank of England notes, and for the rest, carry as their reserve their deposit credits with the bank. A great deal of criticism, from Bagehot down, to go no further back, has been directed at the inadequacy of English banking reserves, and many dire predictions have been made as to the dangers that impended unless the reserves were increased. We shall probably hear less of this after the war. The Bank of England still stands. It has never failed to pay out gold over its counters, even though it has, with the aid of the government, doubtless restricted and controlled foreign shipments of gold. But it has met the unprecedented emergency better than any other bank in Europe, and today, September 1916, is in exceedingly good shape. Sterling exchange at New York seems pegged at the lower gold point, and apprehensions regarding the stability of the English financial system seem definitely allayed. It is aside from our present purpose to discuss wartime conditions. I am rather interested in analyzing the features of the English money market which have made it possible, in the period preceding the war, for English bankers to get on with so little gold. As will appear, it is because English business and financial affairs have been more nearly static, have come nearer to realizing the assumptions of static economic theory than is true of any other country on earth. The very fact, for one thing, that England is the great international banker has meant a scattering of risks. Acute panics do not come in all countries on the same date. Bad business in one country may be offset by good business in another. Drains of gold to one country may be met with gold flowing in from others. The same considerations which tend to stabilize the railroad business, as compared with, say, cotton growing, apply to the international banker as compared with the banks of a single country or section. But further, the London market has developed cooperating agencies for smoothing out friction and eliminating uncertainties to a degree unknown anywhere else. An anonymous writer in the Americas for April 1916 has given an exceedingly interesting account of this organization of the London market, the product of the development of generations. Let us enumerate some of the points. There is nowhere in the world so much expert judgment in the grading and evaluating of hundreds of commodities from all parts of the world. There is, coupled with this, a worldwide reputation for the experts of absolute integrity, so that producers in remote countries regularly ship, consign, to London cargoes without definite arrangements, knowing that there are in London organized facilities by which the commodities are warehoused, expertly and fairly judged, and either sold at once or else made the basis of a collateral loan against which they can draw immediately. The institutions which make this possible are a. the system of warehousing, with its certificates or warrants which give absolute title to the goods, and which are easily negotiable. b. the organized arrangements in connection with the warehouses by which commodities are received and either graded as they are, or separated and mixed with others to form standard blends readily marketable. This with rigid integrity and expertness which the whole world trusts. c. a speculative community which has unlimited banking credit, ready to buy at a concession in price virtually any commodity, honey in the comb, sealing wax, pianos, farm machinery, what not. d. the organized markets or periodical auctions which speculation and final purchase together support. e. the banks, which, relying on the standardization of the commodities and the readiness of the speculative community, can without hesitation lend the money on which the distant shipper is relying to conduct his business. What comes to London is fluid. Everything comes to London. The multiplicity of items dealt in gives stability to that business which deals with all, the banking business. The London Stock Exchange is no provincial affair, easily demoralized by an adverse rate decision. Securities of every country on earth are listed there, and speculated in. It must be a world catastrophe which really demoralizes the London stock market. It will doubtless seem strange to many to say that New York cannot displace London as the center of world finance, that the dollar cannot displace the pound sterling in financing international trade, because New Yorkers do not speculate enough. They do speculate enormously, but not in many things. A restricted list of stock exchange securities, almost wholly American: cotton, in which New York is the world center; coffee, in which New York has the largest volume of speculative futures, though yielding precedence, ordinarily, to Havre, Hamburg, and Santos in spot transactions. There is extensive sugar speculation at the New York Coffee Exchange, which has, indeed, recently changed its name to indicate the fact. There is a produce exchange in New York, but it is a very small affair as compared with the Chicago Board of Trade, and its operations and scope are infinitesimal when compared with the produce speculation in London. Of course, there is a vast deal of unorganized speculation in many things in New York, as in business everywhere, particularly in America. But, while the pecuniary magnitudes of organized speculation in New York are very great, the range of items dealt in is restricted. New York banks cannot possibly get such a variety of collateral, based on standardized and readily marketable goods and securities, as can London. New York, consequently, cannot finance international trade, save as an auxiliary to London, and New York banks must have vastly more gold in their vaults than London bankers need. As goods and securities become more marketable, gold, whose services are needed because of its superior marketability, becomes less necessary. The whole story of London's organization would be a long one. London financial institutions have a degree of expertness, growing out of specialization, in large part, which makes all manner of paper fluid in the London money market which would lack fluidity in New York. The acceptance houses are a sort of international Bradstreet and Dunn. They know intimately the standing and business of houses all over the world. They do not give out their information, but they do put their stamp on the paper of business houses, thus standardizing it, lending, not money, but pure credit, while the other banks, relieved of the necessity of investigating the paper, can buy it as a miller might buy number 1 wheat. There is the extraordinary extension of insurance, so that virtually any kind of risk may be shifted to those well able to bear it. All this makes for liquidity, for static conditions in the money market, and dispenses with the need for gold. As we approach static conditions, we need less and less gold reserve behind bank demand liabilities. The static law of bank reserves is that none are needed. I think we have here the real reason why writers who have sought to give us the law for a normal ratio have given us such vague phrases as shown by experience to be necessary, and the like. When irregularity of income and outgo in a bank's business, non-liquid assets, business cycles, uncertainties, legislative changes affecting business, crop failures, changes in demand, new inventions, wars, are abstracted from, no reason can be given why a banker should keep any reserve at all. But these things are dynamic things. And it is characteristic of irregularities that they are irregular. To get a normal ratio out of them is not easy. On the static assumptions, an ideal credit economy is perfectly possible. If everything that needs to be marketed is perfectly marketable, if the stream of business flows regularly and without friction in the same channels, if all contingencies are foreseen and dated in advance, a bank needs no cash reserve. All payments can be made by bank credit. Bank's bookkeeping becomes merely a refinement of barter, with money remaining as a measure of values, a unit for reckoning, but not being used as a medium of exchange, or as a bearer of options, or in reserves. The measure of values function is the great static function of money. To the extent that static assumptions are not realized, we need money in bank reserves. This extent is a thing that varies from time to time, and from place to place. It is not the same for a given place from time to time, nor is it the same at all places at a given time. It is not the same for the whole world from time to time. Since friction, preventing the free marketing of goods and securities and services, exists, since there are dynamic changes which require readjustments through exchanges, we need the work of the banker and he needs cash. But there are other things than money which make for the statification of the market. The speculator does it, and the other agencies of the sort represented in the London market do it. They are substitutes for gold. Gold has no monopoly. The services performed by gold can be performed in many other ways, and by many other agencies. There is enormous flexibility in the matter. Part 4. The Reconciliation of Statics and Dynamics. Chapter 25. The Reconciliation of Statics and Dynamics. In the foregoing discussion of the value of money, it has appeared that the value of money is not an isolated problem. Not only have we found it necessary to consider it as part of the general theory of value, but it has been advisable to bring it into relation with a large number of the special theorems of economics, including the law of supply and demand, cost of production, the capitalization theory, the doctrine of appreciation and interest, the theory of international gold movements, Gresham's law, the theory of elastic bank credit, and the general theory of prosperity. The book has thus become a book on general economic theory, viewed from the standpoint of the theory of money. It has been as contributing to the problem of the value of money that these other doctrines have been discussed, but I trust that they, too, have gained something of clarification from being considered in this relation, and that the emphasis on the role of money in general economic theory has helped in bringing the various elements in our current theory into a closer-knit interdependence. The present chapter seeks to carry the conclusions so far reached toward a further unification of economic doctrine by finding for certain contrasts, like that between statics and dynamics, a higher synthesis, so that it may be possible for students of dynamics and students of statics to speak a common language, to use common measures, to find that their phenomena are not, after all, of essentially different nature, and to come to agreement as to the relative importance of static and dynamic tendencies. It will appear that the theory of money and exchange plays an important role in effecting that higher synthesis, and is itself clarified by it. The theory of goods versus the theory of prosperity, statics versus dynamics, normal versus transitional tendencies, long-run versus short-run laws, market versus normal price, abstract theory versus concrete description, historical or evolutionary study versus cross-section analysis, temporal versus logical priority, causation as a temporal sequence versus causation as timeless logical relationships. These, and similar contrasts have appeared frequently in the history of social thought, and have been especially refined and elaborated in the history of economics. We have even compounding of the notions into more complicated distinctions, as by Seligman, in his two statements of the law of costs. In the short run, normal price tends to be the maximum cost of production. In the long run, normal price tends to be minimum cost of production. Seligman has illustrated his notion by an adaptation of the familiar figure of the sea level and the waves. For short-run purposes, we may contrast the surface waves, the market prices, with the sea level, the normal price. For longer-run purposes, we may see the level of the sea itself changing, under the influence of the tide, and may have a dynamic normal, which is still to be distinguished from the fluctuations due to the play of winds on the surface. We have further an increasing recognition of the up and down play of forces accelerating and retarding the processes of industry and trade. For earlier writers, panics and crises were anomalies. Since Mill's Principles of Economics, to go back no further, we have had increasing recognition of such occurrences as more or less periodic and inevitable, bound up in the very nature of economic life itself, and of late there has been a fairly general acceptance of the notion of the business cycle, of an alternating rhythm of prosperity and depression. The explanation of this alternation has been attempted by numerous theories, one of which, that of Joseph Schumpeter, rests the whole case definitely in the distinction between static and dynamic tendencies, and in the conflict between the opposing sets of forces which statics and dynamics undertake to describe. We are told by the orthodox economist that war is wasteful, destroying laborers and goods, and lessening the wealth and productive power of society. We are told that it diverts labor from productive employments, that it turns huge masses of capital and labor to the production of goods which men cannot enjoy, that it burdens the people with taxes, etc. Static theory can see nothing but evil in war, from the standpoint of minimizing human sacrifices and maximizing human enjoyments. Nonetheless, we see many war periods, notably that of our Spanish-American War and the present World War, so far as the United States are concerned, periods of marked prosperity growing out of the new expenditures which war itself involves. Mules and other farm products rose in price with the Spanish-American War, as the federal government bought them for the army. Various factories concerned particularly with war munitions increased their activity. The gains of factory owners and farmers led them to increase their purchases. Wages rose, and rose in part because part of the labor force was in the army. The Civil War did spell demoralization and economic ruin for the South, but for the North it gave a great dynamic impetus to trade, transportation, and industry. An impetus, strangely enough, that was so great that the new industries and enterprises which had grown up were able to absorb with little shock the million men set free from the Northern armies when the great struggle was over. For static theory, scarcity is an evil. A general overproduction is impossible. For the practical businessman, confronted with the momentous problem of marketing his output, overproduction is a vital reality, and there are few times indeed when much more could not be produced if only a satisfactory market could be found for it. Static theory would see the whole explanation of this in maladjustment, too much of some things being produced, too little of others. This simple statement does explain much of the phenomenon, but it is far from telling the whole story, and even if it were a complete explanation, it would by no means dispose of the reality of overproduction as a constant menace, even when not a dire reality, facing almost every businessman. Static theory at best tells what a completed adjustment would be. It does not touch the problem of how adjustment is brought about and maladjustment overcome. Yet just that problem is the vital concern of the businessman. For static theory, high or low prices are matters of no concern, and abundance or scarcity of money and credit make no real difference in the economic process. Abundant money and credit exhaust themselves in raising prices, and the rest of economic life goes on unchanged. This doctrine of the quantity theory is, as I have undertaken to show in Part 2, bad even as a matter of static theory. But it is only as a matter of static theory that it is even thinkable. The economic theory of the 19th century, following the lead of Adam Smith and Ricardo, has been accustomed to dismiss as utter folly the notions of the mercantilists as to the balance of trade and the importance of an inflow of gold, and has conclusively proved that protective tariffs tend to divert the labor, capital and land of a country from those lines of production they are best adapted to lines for which they are less well suited. Critics have pointed out, as in the infant industries argument, that we cannot treat the labor capacity and technical knowledge of a country as constants, that the temporary encouragement of one line of industry by a tariff may so modify the data of the situation that the country may in time become better adapted to the protected industry than to other lines. And I think that we may well go further, and make substantial concessions to the doctrines of the mercantilists as they themselves stated them, seeing in a favorable balance of trade, and in expanding exports and diminishing imports sources of impetus which are not subsequently neutralized by the static process of equilibration. I do not conclude from this that protective tariffs are commendable, any more than I conclude that war is commendable. Both may give dynamic impetus, and lead to economic development. Both may lead to political corruption, to iniquities in the distribution of wealth, to waste and suffering of various kinds, in which honest and patriotic men suffer, and cunning and unworthy men gain. The point here is simply that static theory does not tell the whole story regarding either tariffs or wars. It may well be true, I think it is true, that static theory offers the more important principles for judging the results of wars and tariffs. It is the central problem which I have set myself at the outset of this discussion to find a way to bring static and dynamic considerations under a common measure, to reduce them to homogeneity so that comparisons may be instituted, and so that the student of statics and the student of dynamics need not talk merely at cross purposes. But we do not achieve this result by ignoring considerations in either sphere. Bastiat, with a fine show of logic, has sought to rule out of court the doctrines that extravagance and tariffs, etc., are sources of prosperity by his emphasis on the unseen, as opposed to the seen. The prosperity growing out of the extravagant expenditures of one brother is open to all eyes. The consequences of the savings of the frugal brother men do not see so easily, and do not attribute to his frugality. Doubtless Bastiat is right in his main theses. But one point needs emphasis. That which is seen stirs the imagination of men. And imagination energizes human activity. The motivation of economic life is a psychological matter. And so at a host of points the contrast may be drawn, in one or another form. The pure, abstract, static theory gives one conclusion. The other approach suggests one different. How is it possible to give proper weight to considerations drawn from such divergent spheres of thought? Indeed, how shall we weigh the dynamic considerations at all? Static theory presents itself in quasi-mathematical form. At times, it parades itself in equations, and it readily enough, without arousing a feeling of incongruity, expresses itself in mathematical curves, with ordinates and abscissae. One static tendency finds itself in marginal equilibrium with another, and the margin is expressed in quantitative units, commonly sums of money. Static doctrine does, indeed, lay claim to precision and exactness, and static tendencies may be weighed against one another. But how shall one undertake to give quantitative measure to such a thing as the educational influence of a tariff on silk manufacture? How measure the dynamic impetus of a new chain of banks on the industry and trade of the region affected? How gauge the importance of a new advertising scheme or a new invention? Dynamic considerations are commonly presented in vaguer, looser form than static theories. Usually we have merely a statement of a qualitative tendency, without effort to make the importance of the tendency quantitative. Indeed, I think it's safe to say that one chief difference between statics and dynamics is that those tendencies which can be most easily formulated have been recognized by statics, while those which are less understood, and less precisely formulated, are left to dynamics. A big part of the difference is methodological, rather than inherent in the nature of the phenomena themselves. I think that it needs little argument to show that all the contrasts listed at the beginning of this chapter do not run on all fours. Compare, let us say, the contrast between statics and dynamics with that between historical and cross-section study. Concrete, realistic history is not dynamic theory. A realistic description of society viewed at a given short period of time is not static theory. Both statics and dynamics are abstract. Laws are not the same thing as description and narration. The assertions of both statics and dynamics are commonly made on the assumption, caeteris paribus. A new bank will stimulate business in a western town if bank robberies do not come into fashion. A tariff on wool will tend to educate the farmers in sheep raising if the habit of relying on governmental assistance does not develop, and make them more, rather than less, inert, or sharpen their political rather than their economic acumen. Concrete history need not always verify dynamic laws. It is, above all, important to insist that the distinction between statics and dynamics is not the same as the distinction between theory and description, or between the abstract and the concrete. Evolutionary study may result either in concrete history or generalized laws. Cross-section study may be either concrete description or abstract formulae concerning forces in equilibrium. And there may be varying degrees of abstractness in both cases. The contrast between long-run and short-run tendencies is not necessarily the same as that between statics and dynamics. This former distinction does recognize one factor which is sometimes classed as dynamic, namely, friction. Friction, by the way, is a blanket term which covers a multitude of sins of imperfect analysis and lazy thinking. It is far from a simple, unitary thing. Sometimes it seems to mean the action of the whole social order, other than the economic values. But dynamic, as used by the two writers who have used the term most precisely, J. B. Clark and J. Schumpeter, is reserved for those factors in economic life which make for constructive change. Neither writer would call mere habit and inertia, which make readjustments slow, or the necessities of physical nature, which retard readjustment, by the name dynamic. It may be noted, in passing, that both writers limit the term quite strictly to changes in economic life growing out of economic causes. Schumpeter narrows the dynamic factors to one, namely, enterprise, while Clark gives 5 general classes of dynamic factors, all of which are primarily economic in character. Neither extends his study to cover forces which are not primarily economic in character, but which nonetheless lead to economic changes. Again, the theory of prosperity is not identical with economic dynamics, though the two in large measure overlap. For one thing, while some writers, as Schumpeter, find the business cycle to be a necessary consequence of dynamic changes, and would maintain that no business cycle, no up and down of tempo in production, no panics or crises, are necessary if changed methods of industry, etc., did not come in, not all writers would so explain the business cycle. Some writers would find the explanation in the inherent instability of a money and credit economy, some in the inherent weakness of a capitalistic system, quite apart from necessary dynamic change. Irving Fisher makes no use of changed methods of production in his explanation of business cycles, though he does mention invention as one possible cause of a disturbance in normal equilibrium. But further, dynamics is largely concerned with problems, like invention, changes in the economic habits of a people, methods of organizing industry, etc., which, while they may well bear on the problems of prosperity and depression, yet have interest for their own sake, and would be studied if there were no business cycles. Further, the notion of statics, the other term in the static-dynamic contrast, is not identical with the theory of wealth, or theory of goods, or theory of the wealth of nations, which such a writer as Veblen would put in contrast with his theory of prosperity. There is a normative, or practical, and polemical coloring in the body of doctrine growing out of Adam Smith, which Veblen would term the theory of the wealth of nations, which is lacking in the more colorless statics of today. I do not find any of the contrasts thus far discussed quite satisfactory. I have been using the terms statics and dynamics as general terms to cover all these contrasts. I shall try to formulate a general contrast which includes most of the ideas passed in review from a somewhat different angle, and then try to show that the contrast, while useful, is not absolute, and that it is possible to measure considerations drawn from one viewpoint in terms of considerations drawn from the other. Let us take as our starting point the notion of a cross-section picture of society. I have set forth this notion in ch 13 of my social value, and have elaborated it in the discussion of von Mises' theory in the chapter on marginal utility in this book. A cross-section picture may be made more or less concrete and descriptive, or abstract and analytical. If one looks at the picture of society in cross-section as given by Giddings in his Principles of Sociology, Book 2, chapters on the social population, the social mind, the social composition, and the social constitution, one finds a picture in which organization and system are made clear, but in which vivid description of concrete social facts is the primary concern. The account given is largely qualitative rather than quantitative. It is a picture of flesh and blood, as well as an account of functioning. It is, perhaps, not easy to realize that Giddings is doing the same general sort of thing that the pure economic theorist is doing with his picture of a static equilibrium of economic values. But what economic theory is concerned with is, after all, to be found in Giddings' scheme. The pure theorist takes for granted the physiographic environment, whose influence Giddings takes into account. The theorist abstracts from biological and racial factors. He assumes a social population, a social order, a political system. He has not taken into his purview the social mind as a whole in his static theory. Rather, he has been concerned with only one part of the social mind, namely, the economic values. Economic values, and the objects of economic value, have been the data of the static theorist. Given scales of economic value, such that for one quantity of goods of a given kind, a given value per unit will obtain, given all of these value scales, and given the quantities of goods and services whose values are in question, and static theory will furnish an equilibrium picture, in which the price relations of different kinds of goods are made clear, and their values are measured. The value scales, and the absolute magnitudes of value at different points on the scale, are assumed, are data. Further, in order that the notions may be made mathematically precise, a unit of value is needed, and this is commonly the value of the money unit, which is assumed to be constant. The picture then becomes systematic. There is a system of values, expressed in prices, which is stable, so long as the data do not change. It is mechanically conceived, and illustrated by various mechanical symbols, as balls in a bowl, or connecting reservoirs, or, best of all, by intersecting curves. It is an abstraction from the living, pulsing, organic whole of the social mind, the intermental life of men in society. It squeezes much of the life out of the phenomena it describes. It makes them exact, only by making them mechanical. It thus becomes exact by becoming, in considerable degree, superficial and abstract. This is not to condemn static theory. Static theory has proved its usefulness by solving too many problems for such a statement of its limitations to involve a condemnation. But the statement of its limitations will aid us in seeing its relation to that vaguer body of doctrine which we call dynamics, or the theory of prosperity, etc. Now this means that static theory is not value theory. It assumes a theory of value. It assumes the value scales as data. It assumes the value of money as a datum. Static theories of supply and demand, cost of production, capitalization, etc., assume the value of money, as has been shown in Part 1, and static theory, resting in the notion of accomplished transition, normal equilibrium, abstracting from the difficulties of readjustment, abstracting from friction, etc., misses the whole point as to the functions of money, as shown in Part 2. Static theory proceeds by assuming a change in one of the elements of its situation, say one of the value scales, and then tells what the new equilibrium will be after readjustment takes place, assuming that other value scales remain constant, and that quantities of the objects of value do not change. Or, it assumes a change in the quantity of one of the objects of value, and then predicts the new equilibrium. The new equilibrium will often involve changed values and prices all around, and will often involve altered quantities of other objects of value. But the initial change comes from an alteration from outside the system in one or more of the data of the system. Now dynamics, theory of prosperity, etc., are concerned with the causes of changes in the data with which statics works, in large measure. Among the problems with which statics has not adequately dealt, and in large measure cannot deal, are 1. The nature of value itself, and the laws governing changes in the value scales. 2. The problems of readjustment, including the problems of money, credit and exchange. 3. The psychology of invention, of enterprise, and the like. 4. The reactions of economic values and economic organization on the non-economic phases of social life. 5. The reaction of the non-economic factors, as law, morals, art, religion, etc., on economic life. 6. The problem of prosperity and depression. I say that statics has not dealt adequately with these problems. Statics, in its present narrow form, cannot deal with them. But in considerable degree, I am convinced, statics can be made to deal more adequately with them, if its scope be broadened, and its limitations be made less rigid. Schematically, at least, the central ideas of statics can be applied to a large part of these problems. I may add that my list of 6 classes of problems with which statics has not adequately dealt is not meant as a system of categories. The list is incomplete, and the classes are not mutually exclusive. Rather, they overlap in large measure. In a large way, it might be said that statics is concerned with the laws of the equilibration of values, and that dynamics, theory of prosperity, etc., are concerned with the nature and causes of variations in the values themselves. The contrast may be put, in general, as the contrast between the theory of value and the theory of price, statics being price theory and dynamics being value theory. But this is a thesis which calls for much elaboration and qualification before its significance is made clear, to say nothing of its justification being established. We may approach the problem of bringing the two terms of the contrast together from either of 2 angles. 1. We may show that dynamic factors tend, in large degree, to submit themselves to measurement in terms of money prices, which obey the laws of static marginal equilibrium. 2. We may show that all static prices presuppose values whose explanation is in terms of the same phenomena with which dynamics, the theory of prosperity, etc., have busied themselves, namely, considerations drawn from the study of social psychology, including the psychology of suggestion, imitation, mob mind, the functional organization of minds into a social mind, social beliefs, social values of other than economic nature, and social institutions. 1. The evidence on the first point is already in considerable measure worked out, particularly by Veblen, in his theory of business enterprise, and in his other writings on the nature of capital, etc. Something more in this direction I have done in my social value, and other writers have elaborated the notion. 2. The case for the second contention has been made in detail in my social value, and in what follows I shall rely chiefly on the discussion presented there, and in the chapter on value in this book. I take up first the thesis that dynamic factors may come under the static measure. Veblen has made much of the contention that modern capital is not, as Smith thought, and as orthodox economists in general have contended, a matter of physical accumulations of goods. The volume of business capital is a pecuniary concept, and may wax and wane with little variation in the physical stocks. Under modern conditions, the magnitude of the business capital and its mutations from day to day are in great measure a question of folk psychology rather than of material fact. Theory of Business Enterprise, page 149. And in large measure Veblen's work is given to showing how factors of legal and social psychological nature get a money measure. The actual capital of a business enterprise does not rest chiefly on the physical equipment, stocks of raw materials, etc., etc., which it possesses. To be added is goodwill, and this includes, page 139, established customary business relations, reputation for fair dealing, franchises, privileges, trademarks, brands, patent rights, copyrights, exclusive use of processes guarded by law or secrecy, exclusive control of particular sources of materials, etc. Veblen contrasts things of this nature sharply with the concrete equipment, saying that the former are serviceable only to the owners, while the latter are serviceable to the community at large as well. The physical, tangible, and ethically commendable character of the physical equipment is everywhere stressed, while the pathological, anomalous, and sinister character of the less tangible and more recent capital items is always set before us, all the more effectively because Veblen maintains a satirical attitude of moral indifference and presents the case with Olympian aloofness. I am not here concerned with the social welfare aspect of the matter, though I shall later speak of that. My present purpose is to make clear 2 points in Veblen's doctrine. 1. That he does bring these intangible things, which are the variables involved in his theory of prosperity, under the price measure, and 2. That he considers these prices as anomalies from the standpoint of the general laws governing the values and prices of concrete goods. To this last point I shall later take sharp exception. For the present, I wish to develop further the extent to which such factors may be brought under the general static measure. The feature of static theory which Veblen chiefly employs in giving a money measure to his intangible capital is the capitalization theory. The capital magnitude of the items of goodwill previously mentioned is a capitalization of the income which they are expected to bring in. And it may be said that a large part of Veblen's doctrine of the causes of the ups and downs of business rests on the complaint that this capitalization process is not rationally carried through, that incomes are overestimated, and that businessmen are tenacious of capital magnitudes once built up, and refuse to mark them down properly when the facts in the situation have changed. His theory of prosperity thus rests on non-rational enthusiasm on the one hand, and a certain kind of friction on the other hand, and apparently the difficulties in the situation as he sees it would largely disappear if these two elements could be rationalized, and the static theory work more perfectly. The elements involved in the capitalization theory, as shown in the chapter on that topic, are three: the anticipated income, the prevailing rate of discount, and the capital value, the last named being the child of the first two. The capital magnitude is a shadow, where the income is the substance. Veblen seems to find the trouble arising in that the capital magnitude takes on a substantial character and refuses to play the passive role of shadow. It is interesting, in passing, to compare this theory of Veblen's with the theory of crises developed by Irving Fisher, from the standpoint of a body of doctrine which is purely static, and which Veblen has criticized as taxonomic in a high degree. For Fisher, the trouble arises from friction in connection with another element in the capitalization problem, namely, the interest rate. Businessmen think that a dollar's a dollar, and refuse to let the interest rate be marked up in accordance with the doctrine of appreciation and interest. This, likewise, leads to overcapitalization, leaves the passive shadow too big. I must confess that it seems to me that one theory is about as taxonomic as the other, that both rest on pointing out divergences from a static, taxonomic norm. In general, Veblen's work in this field consists in assimilating the intangible capital to the class of land and other long-time concrete income-bearers, but that is after all classification, systematization, taxonomy. In saying all this, I am as far as possible from questioning the value of Veblen's work. Rather, I rate it as of extreme significance. Taxonomy does not appear to me so dreadful a word as it does to Veblen. I should rather say that some taxonomy is good and some is bad, depending on whether or not it leads to fruitful generalizations and deeper insights. It is, as I have said, chiefly the capitalization theory which Veblen applies to these newly important intangible capital items. The phenomena of the stock market, where such things are most actively bought and sold, and where they appear as differential portions of the capital values of securities, doubtless first called attention to them, though the item of goodwill as a business asset, for which a money price is paid when businesses change hands, is doubtless older and wider than modern corporation finance. The capitalization theory applies to them most readily and obviously, as compared with other elements in the static theory of prices. But as we become better used to the large role which these phenomena play, not that the phenomena are new, but that their present importance is new, and hence our serious study of them is new, we are increasingly able to see that other elements of static theory also apply. Static theory applies increasingly as understanding increases. The vaguely discerned, the novel, the imperfectly analyzed, can be stated only in qualitative terms. As things are better understood, the mind seeks system, taxonomy, quantitative measurement. Businessmen today are well accustomed to applying cost concepts to many of these intangible magnitudes. Advertising, for example, is being worked out with increasing exactness, and businessmen are increasingly applying accounting processes to the determination of the question of how much advertising pays. Well-known brands are capital items. Well-known brands have cost money. Businessmen contemplating the marketing problem may well balance the cost of creating a new brand against the cost of buying an old one, and may balance the cost of creating a new brand against the profit to be made from allowing an old one to deteriorate through cheapening its process of manufacture. Trade connections are capital items. They are also items which have been created by patient thought and labor and expense. Franchises, since the days when the public awoke to their value, have cost money to the corporations that possess them, and figure in corporate bookkeeping often. Even in the old days, they often had a cost, which commonly stayed out of the corporation's books, at least in that form: bribes, entertainments to legislators and members of councils, and so on. In Part 2 of this book, I have discussed selling costs as contrasted with costs of production in the narrow sense, and have pointed out how high a proportion of total costs these selling costs are. I have also indicated how many of these costs tend to be capitalized. These selling costs are static measures of the elements of friction, which interfere with the smooth working of static laws. An extension of statics, however, can in considerable degree take account of them. It is, of course, far from true that cost doctrine will explain all of these intangible capital magnitudes. But this is likewise true of the prices of many tangible items. Cost doctrine does not hold universal sway even in the confines of the strictest static theory. I have said that dynamic factors tend to come under the rules of static taxonomy to the extent that they become more accurately understood. The understanding here referred to is not merely on the part of the scientific theorist. The subject matter of economic science is itself psychological. It includes the psychology of the businessman, as well as the psychology of purchasers and laborers, and the general field of social mental life that bears on economic processes. It includes the theories of the businessmen, as well as their aspirations and motives. It includes their methods of computation, and the accuracy or inaccuracy of their prognostications. It has been pointed out recently that at the current price of copper, 22c per pound in January 1916, the prices of copper stocks are very much lower than they were when copper reached the same price some years ago. Calumet and Hecla stand some 200 or 300 points lower than it did then, and the same percentage difference is manifest in the case of many other stocks. But the explanation which the broker and market writer offer is that people have awakened to the fact that mining stocks are stocks with wasting assets, that the incomes from copper stocks cannot, therefore, be capitalized on so high a basis as similar incomes from other securities, that people today realize this fact as they did not some years ago, that the earlier capital prices of copper stocks were vastly exaggerated on the basis of a careful estimate of probable total future income, etc. Japan, little used to the great prosperity growing out of sudden great increases of special kinds of business, found herself in such an orgy of war stock speculation that it was necessary to close the stock exchange in 1915. The United States, better familiar with the phenomena of boom and depression, seasoned by many experiences of similar nature, have found that on the whole, at least in the opinion of many competent judges in January of 1916, war stock speculation has been kept in reasonable bounds, thanks in large part to the conservatism and caution of bankers and brokers, and that the general economic situation is in fairly stable equilibrium, with most of the probable sources of disaster foreseen and discounted. To discount is to make static. Whatever the businessman can reduce to bookkeeping terms, and whatever he can measure by money in the market, the economist should be able to bring within the orderly sequences of economic law. In social value, I have pointed out how wide is the scope of the money measure. Waves of public opinion, of waning or waxing hope and belief, of patriotic fervor, of religious exaltation, of political movements of one or another kind, all these find some sort of money measure in the market. In the gold market in the early 60s in New York, the bulls sang Dixie, and the bears sang John Brown's Body. It was patriotic to be a bear, and unpatriotic to be a bull. These considerations affected the prices very appreciably, at times, especially at the beginning of the speculation in greenbacks. Waning and waxing belief in the triumph of the Northern armies manifested itself very strikingly in the prices in the gold market, as W. C. Mitchell has conclusively proved, with a wealth of detailed evidence, in his history of the greenbacks. But in less systematic markets, in less organized and regular ways, many things besides are given a money measure. Against what, indeed, shall wealth be measured? Where are the markets which measure its fluctuations? But such markets exist, always have existed. Are there not streets where woman's virtue is sold? Are there not commonwealths where there is a ruling price for votes? Do not the comparative rewards of occupations indicate what inducements will overcome the love of independence, of safety, of good repute? We see men sacrificing health, or leisure, or family life, or offspring, or friends, or liberty, or honor, or truth, for gain. The volume of such spiritual goods mammon can lure into the market measures the power of money. When gold cannot shake the nobleman's pride of caste, the statesman's patriotism, the soldier's honor, the wife's fidelity, the official's sense of duty, or the artist's devotion to his ideal, wealth is cheap. But when maidens yield themselves to senile moneybags, youths swarm about the unattractive heiress, judges take bribes, experts sell their opinions to the highest bidder, and genius champions the cause it does not believe in, wealth is rated high. Ross, Foundations of Sociology, pages 171 to 172. Ross is here interested chiefly in the problem of measuring the varying significance of wealth, symbolized by money, in terms of other and non-economic goods. But it is equally true that money measures these goods. The range of the money measure is very wide. Nor is it confined to the exchanging process. Gabriel Tard has pointed out that money may function as a measure of non-material goods through gifts, public subscriptions, etc. It is surely no extravagant claim to make that the methods of static economics may be extended at least as far as the money measure goes. We shall later see reason for believing that fruitful results may come from an even wider extension of the static notion, at least as a schematic device. In reducing static and dynamic considerations to common terms, we have now gone far. We have shown that a wide range indeed of the phenomena deemed dynamic, and largely ignored by current static theory, left to the discussion of such innovating students of the theory of prosperity as Veblen, are really in the actual practice of the business world treated in the same way as are the static phenomena of the values of physical goods and concrete services. And we have further shown how wide indeed is the scope of the static yardstick, the dollar. But this is only a part of the story. We have generalized statics. Can we similarly generalize dynamics? Or has our generalization of statics merely narrowed the field of dynamic considerations? To this I reply that we may view the whole field likewise from the angle of what we have called dynamics, or theory of prosperity, or similar name. These terms are not satisfactory, in my view, and I have already used terms that appear to me better. My exposition on this point will be briefer than in the generalization of statics, since I may refer to what I have said elsewhere. In stating Veblen's contrast between business capital and the wealth of nations, I quoted him as follows: "Under modern conditions, the magnitude of the business capital and its mutations from day to day are in great measure a question of folk psychology rather than of material fact. The capital, or the wealth in general, of older and simpler days was a material matter, concrete goods and services, in his view. The newer items of capital are anomalies, presenting something strange and novel and sinister. I should maintain that, whether sinister or no, they are in principle at least not novel or anomalous. All economic values are matters of folk psychology. All economic values are social values. All are to be explained on the same general principles that explain the values of the most complicated stock market phenomena, except, of course, that the application of the principles involves less complication in the case of such values as that of a loaf of bread. But value is always a matter of psychological significance, and never a matter of mere material fact. And these psychological significances are not explained by such simple individual phenomena as labor pain or marginal utility, but always by reference to the total social mental system, including its laws, its mores, its institutions, its centers of power and prestige, its modes and fashions, etc. If Veblen has in mind the contrast between goods whose values rest in labor pain or marginal utility, on the one hand, and values which rest in a folk psychology on the other hand, the contrast is a false one. The first class does not exist. I shall not elaborate this point. I have developed it at length in Social Value, and in the chapter on Economic Value in this book. I should make the contrast, then, which seems to me to gather up the central significance of most of the contrasts we have been discussing, as follows. On the one hand, we may view the matter mechanically and abstractly, in terms of the equilibration of values conceived of like physical forces, expressed in prices. On the other hand, we may view the economic situation more fundamentally and realistically, seeing the interplay of men's minds, viewing economic values as parts of a social mind, a functional unity of many minds. We may treat society as a mechanism, or we may treat it as a living, pulsing, psychological organization. In short terms, our contrast may be between the theory of value and the theory of price. And here we are back to our thesis set forth on page 559 of this chapter. The theory of value, as thus marked out, is still an abstraction from the totality of our cross-section picture of social, or even of economic, life. The essence of society is indeed psychological. But men have bodies, and live in a material world, and have an elaborate technology. Many of the factors which students of dynamics are concerned with grow out of biological and technological relationships, and are connected with physiographic influences. Can we bring all these into our scheme? Giddings and Spencer would answer affirmatively. For Giddings, Principles of Sociology, edition 1905, page 363, all social energy is transmuted physical energy. Giddings guards himself, pages 365 to 366, against a thoroughgoing monism, which would leave no distinction between mind and matter, but in general he would hold to the scientific goal of reducing the physical and psychical phenomena in society to a parallelism, so that concomitant percentage variation could be predicated of them, and so that considerations in one sphere could be expressed by considerations in the other. In the hands of Giddings and Spencer, such notions are handled with caution and discrimination, and command respectful consideration. One feels, however, that the starting point is a monistic metaphysics, and that the philosophical doctrine does not justify itself in its scientific application. In the hands of such a writer as Winiarski, however, Reverend Philosophique, Volume 45, pages 351 to 386, Volume 49, pages 113 to 134, summarized by Ross, Foundations of Sociology, pages 156 to 157, who makes all mental states mere forms of physical energy, and applies to mental processes the laws of mechanics, the doctrine becomes merely bad poetry. From the standpoint of the needs of social science, and from the standpoint of our present knowledge of social facts, to say nothing of general philosophical considerations, it seems clearly best to me to assume the common-sense doctrine of dualism as a premise. Mind and matter are two different things. Mind acts on matter, and matter acts on mind. We are then at this position, when it comes to bringing technological and physiographic factors into our scheme. On the one hand, the values control technological applications and control the course of industry. New technological devices will be employed when the present worth of their anticipated products is great enough to overcome the values that compete with them. Land will be employed on that crop which gives the largest rent, etc. Men's physical activities, and their employment of their physical resources, are motivated by values. That is the function of values. On the other hand, physiographic and technological factors modify the lives and characters of men and peoples. Values are in part controlled by physiographic and technological conditions of life. But these technological and physiographic factors, in order to influence economic conduct, must first influence the value system. This they do, 1. By affecting the quantities of objects of value, and so modifying the marginal relations among the value scales and the marginal values. 2. By affecting the lives of the people directly, and so modifying the value scales themselves. Similarly, I see no way of bringing the vitally important factor of heredity into our scheme in a direct manner, in propria persona, but only mediately, as it 1. Affects the character of the society, and so changes its value system or its technological activity and volume of products, or 2. As heredity becomes a matter of concern to the society, and so an object of value, with its own place in the value system. There remains, therefore, in the field of technological, biological, and physiographic features affecting economic life a considerable residuum of economic problems for which, so far as I can see, no extension of the static method can be devised. I propose no scheme of static price analysis for balancing the effects of poor land and good heredity on the character of a society. The problem must be approached by other methods specially suited to it, which we need not here discuss. But, given the values that rule in that society, we may be sure that our static picture of that value system will sum up much of the influence of the bad land and the good heredity, mingled with the other factors which have determined that set of values. Once a factor has been introduced into the value system, once it has modified the value scales, we may treat it by the methods of static price theory. The analysis of the factors controlling the value scales is the problem of value theory. And here is, indeed, the central problem of the theory of prosperity. What are the causes controlling the mutations of values? What factors cause values to rise, intensifying economic activity, stimulating trade, spreading prosperity? What brings about the crash in economic values, and consequently in prices, in panics and crises? Why the low values of the period of depression, giving slight stimulus to industry and trade, leaving economic life lethargic, inert? Increasingly, it is recognized that the problems are problems of values and prices. It is no part of my plan to give answers in specific terms to these questions. That were the task of a large book, and very much of it has already been done. It is my purpose here, simply, to show that price theory, as developed on the basis of static notions, may be extended, and has in considerable measure been extended, to cover these problems, and that for the same reason that price theory is unable to give really fundamental answers to them, often, it is likewise unable to give fundamental answers to the value problem anywhere. That the phenomena of value are of the same stuff and substance as the phenomena treated by dynamics and the theory of prosperity, and that static theory has been busied chiefly with a limited portion of the field only because the problems were easier there. Much has been made, especially in such a book as W. C. Mitchell's Business Cycles, of technological factors, and of factors in the psychology of the businessman and of the laborer in the ups and downs of business, and particularly of certain elements of scarcity or overabundance of productive resources at critical parts of the economic system, which raise values and prices unduly at certain points. compelling radical readjustments of values and prices elsewhere. Virtually all of these considerations will fit into the scheme here outlined. They work through modifications of the system of values and prices. H. L. Moore's recent economic cycles lays heavy emphasis on physiographic factors, particularly variations in rainfall. But these, too, act on the economic situation through affecting the quantities of objects of value, and so through modification of the marginal values of goods. The psychological theory of economic value by no means excludes any amount of influence one can find in physiographic or technological factors. One of the most important factors in the minds of many writers who would treat business cycles, and a factor to which virtually all writers give attention, is the waxing and waning of business confidence and of the volume of credit. I have given an extended analysis of the psychology of confidence and of the psychological nature of credit in my chapters on that topic. It is enough to say here that we have in credit phenomena things which are of the very stuff of economic values in general. Beliefs and hopes are factors in economic values, and values wax and wane with them. There is little indeed in the psychological and institutional aspects of the theory of prosperity which an adequate theory of value would not contain. The theory of prices, as an abstract formula of description, is of primary interest to the scientist, who has nothing to do with the manipulation of concrete values, and who has no interests at stake in the behavior of particular values at a particular time. His purposes are ultimately practical, no doubt, but the practical ends he has in view are, after all, only to lay down general rules of public policy of a high degree of generality, and he consequently may abstract from a great deal of the concrete causal process. The theory of value, in its concrete fullness, is the special interest of the active businessman, and especially of the businessman who wishes, not merely to adapt himself to changes in values, but also in part, to control and manipulate those values. He must study every factor which does, in fact, bring about changes in the value system. We do not find the market letter of a brokerage house, or the calculations of a captain of industry or trust promoter troubling themselves about marginal utilities or labor pains. Notions of supply and demand, and the relations of the prevailing interest rate to the capital values of securities, they do employ. Notions of money costs of production they make use of. But they also give very close attention to questions of governmental policy, to court decisions, to movements in the field of labor organization, to money market phenomena, and particularly to gold movements and the state of the exchanges, to political campaigns, to the strength of the prohibition movement, to changing fashions and modes, and, above all, to the general tone, the consensus, so far as it is ascertainable, as to whether business is good or bad, whether men are buoyant or depressed, to the ups and downs of business confidence. They pay marked attention to the opinions expressed by certain men, great bankers or industrial leaders, not merely because they think these men good judges, but also, and in part primarily, because these men are centers of power, radiant points of social control, whose opinions make the opinions of others, and whose statements that times are good tend to make them good, and that times are bad tend to make them bad. For static theory, nothing is more contemptible than the view which demagogues often express in Congress that great men in Wall Street make and unmake prosperity, bring about and check panics. For static theory, the only way that big men can lower prices is by selling, and the only way they can raise prices is by buying. Their power to raise and lower prices is thus limited by the amount of their wealth which they are willing to employ in this way. As it is not likely to be profitable to be a bull when the general condition of the fundamentals calls for falling prices, and as bare operations, contrary to the fundamentals, are likewise usually costly, the inference would be that the big men will not, even if they could, alter the course of the market. Their wealth is, after all, not so tremendous, as compared with the aggregate wealth of the rest of the community. But the market takes the big men more seriously. When they are selling heavily, other men are often afraid to buy, such is their prestige. When they give out opinions, these opinions become the opinions of a host of others, almost automatically. When Morgan stepped into the breach in the panic of 1907 with $25 million, it was quite as much the fact that Morgan had acted, as it was the millions themselves, which relieved the situation. Indeed, it was in no small degree the prestige of Morgan which relieved the disorganization, which restored the discipline, and made it possible for the elements in the market to work in harmony and cooperation again. Society is a functional unity, and the tone of business, the ups and downs of prosperity, depend in large measure indeed on the degree to which the lines of communication between the different parts are kept open, on the question of whether each part does its expected task at the right time and in the right way, on the altogether functioning, the integration of the elements. These are phases of the matter from which static theory abstracts. They are organic problems, not mechanistic problems. Of course, mechanisms get out of order too. But tightening a bolt is a very different thing from restoring confidence and discipline to a market. Those who wish to control values have their own technology. There is a technology of industry, a mechanical technology, running in terms of pistons and levers and soil fertility equivalents, and butter fat content and ton miles, which is governed by the values. But there is also a technology of controlling values which involves advertising, making sentiment, keeping up social discipline, affecting the equilibration of values by exchange, keeping interstitial adjustment smooth, which involves a different kind of activity, thought, and ability, and which employs different instrumentalities. Its problems are problems of human nature and social relationships. Its laws are psychological laws, particularly the laws of suggestion, imitation, and the like. Its tools are the newspaper, the signboard, the whispered word, the cigar and the dinner with wine, sound logic, money and credit instruments, the prestiges of men and institutions. For men whose work lies in controlling and making values, rather than in making passive technical adjustments to existing values, the theory of value, as I have defined it, is of supreme importance. This, I may say for the critic who may consider the social value theory a highly speculative and theoretical notion, does not mean that the active businessman or the advertising writer has formulated the social value theory in terms of a social mind, conceived of, in the light of modern functional psychology, as a functional unity of individual minds. The advertising writer is a student of modern psychology and reads books on the psychology of advertising, which discuss the psychology of suggestion, and the like. But long before such books were written for him, he studied the phenomena involved in his own way. It is not his business to construct a theoretical economics. It is his business to make a market for his wares. He is interested in the scientific theories of modern social psychology only in so far as they help him in that task. He has no occasion to construct a vast conspectus, which shall summarize the whole economic situation in its social setting. But my point is, simply, that the kind of phenomena which he does study are indicated and stressed and brought into a system in the theory of social value which I have tried to elaborate. As his purposes are different from those of the economist, his method of approach, and his range of investigation will necessarily be different. The notion of dynamics has been in a way connected with the idea of evolution, of historical process in time, while the notion of statics has been essentially connected with the notion of a cross-section, a stage, an equilibrium of contemporary forces. How, then, bring the two together? Of course, we may conceive the evolutionary process itself as a series of stages, and the mind does tend almost inevitably to do that. The fact is, of course, a perpetual flow, with unceasing change. The mind grasps such a notion with difficulty, if at all. Logic is mechanical and mathematical, and mathematics and mechanics are static. But further, we may in large measure bring the historical considerations into a cross-section picture when it is a value system that is involved. Past facts exert their influence through present values, and future facts, which may be expected to modify future values, come into the present equilibrium as discounted present worths. When we view the situation realistically, moreover, which means when we view it as a living organic psychological process, our cross-section does not need to be narrowed to a moment of time. We may see the values not yet in stable equilibrium, but in process of equilibration, with marginal values and prices fluctuating, tending toward a static goal, but hindered by various cross-currents of friction, of uncertainty, of momentary values which rest on beliefs regarding the process of transition itself, as when a bull on the war stocks turns bear temporarily, because he thinks that prices may fall before recovering themselves, and going higher. We may see obstacles in the way of readjustment whose importance is itself subject to static measure, labor temporarily out of work, and labor time lost, at so much per day, uncertainties which give rise to speculation, which calls for the employment of extra banking credit at such and such %, capital instruments which have to be scrapped, representing the loss of so many dollars. We may see the process of building up new trade connections at such and such a cost, to replace others which formerly functioned, but which no longer serve, which were once worth so much, and which now are valueless. Watching the realistic process of transition, through a period of time, we may still apply our static yardstick to many of its features. Above all, do we get in this connection a realization of the fact that the immaterial capital of which Veblen speaks is true social wealth. Whatever is necessary for the carrying on of economic life, whatever, if destroyed, must be replaced, before the economic process can go on, and will be replaced by the expenditure of labor and thought and money, is capital. The sales force is as truly a part of the labor force of a corporation as are the mechanics. The trade connections which the sales force has built up is as truly a part of the capital of the business as the machines which the mechanics have made. The static theory which abstracts from this easily leads to dangerous conclusions. Removing a tariff may well, after the transition is completed, give a greater productive efficiency to a country. But what of the cost of transition? May not the values destroyed, and to be recreated, in the form of trade connections, social organization, accomplished adjustments, and the like, be greater than the new values to be gained by better adaptation of industry to the physical resources or the capacities of the labor supply of the country? In large measure, this question, in a given case, is susceptible to a quantitative answer. The statesman who reckons only the gains which the final static adjustment will bring, and neglects the costs of reaching it, costs not alone in scrapped machines, but also in scrapped social organization, has missed a substantial part of his problem. The theory of prosperity and the theory of value are largely concerned with just this system of social control, by means of which value scales are altered, and by means of which altered values are brought into a new equilibrium. It is a complicated fabric of psychological relationships, partly institutionalized, partly non-institutional. The institutions, as banks, big corporations, speculative exchanges, and the like, are the nuclei, about which center much that is temporary, shifting, and flexible. Given time, the whole system is highly flexible. It is organic and not mechanical. The serious injury of this system in a country may well be a greater disaster than the destruction of physical items. Let unscrupulous men, or misguided men, bring about a legal repudiation of debts, and the disaster may be greater than the destruction of a city by an earthquake. That creditors have been robbed is a minor matter, but that credit has been shaken, so that men will fear to lend again or to sell except for cash, may well mean industrial paralysis. Considerations like these enable us, in substantial degree, to reduce transitional considerations to common terms with normal considerations. We can apply the static measure to the transitional considerations, and we find the values which come into equilibrium in the normal period to be generically like those whose variations interest us in the period of transition. Indeed, the normal equilibrium, if it were ever reached, would also contain these intangible capital items, though many of them would be much reduced, since the work that they have to do would be largely gone, if the normal equilibrium were persistent. It does not follow from the foregoing that many of the elements in modern business capital are not, as Veblen's analysis suggests, sinister and antisocial. To say that their values are true social economic values, generically the same as the values of wheat or corn or whiskey or opium or synatogen or milk or tickets to burlesque shows, or silver sacramental sets, or Ford automobiles, is not necessarily to give them a good moral character. Some of these intangible capital goods are thoroughly antisocial and should be destroyed. This is particularly true of monopoly power and of popular brands whose value rests in popular delusion. But even here, caution is needed. Is it socially wise to destroy a wine cellar containing $100,000 worth of fine wines, even assuming that Demon Rum is as black as he is painted, and that Veuve Clicquot is his favorite daughter? Will not the economic values which have been destroyed in this moral fervor be recreated? And will not this tend to divert labor and capital from the creation of a corresponding amount of more wholesome economic goods? Might it not be wiser from the standpoint of the temperance movement itself to sell the wine cellar, at private sale of course, and use the proceeds in the campaign fund of the Prohibition Party? Of course, there is more still to the story. The destruction of the wine cellar may be done so dramatically, and may be so well advertised, that it will arrest public attention, and tend to create new social values, of a moral and legal sort, which will prevent the recreating of that wine, by changing the direction of demand, and by lessening the sources of supply. Similarly with trade connections, and other intangible capital items. If destroying one means merely that labor and capital will be employed in making others no better, the social gain is very doubtful. And some sort of system of control of interstitial adjustment, of overcoming friction, etc., there must be. I wish to contrast the view I have been here presenting with that developed by Schumpeter in his Theorie der Wirtschaftlichen Entwicklung. In Schumpeter's view, the division between statics and dynamics is much more than methodological. The phenomena of statics and dynamics are different phenomena. Statics is concerned with the influence of individual utility scales, or utility scales and psychic cost scales, hedonistic phenomena. Dynamics is concerned with the influence of Energisch as distinguished from hedonish factors. Locke. Cit. 128. Most men are moved by hedonic considerations. Their economic activity tends toward the equilibrium described in static theory. Seeking to maximize satisfactions and to minimize pains, they tend to get into the best possible situation, best possible under the given conditions, and stay there. The energetic type of men, moved by motives like love of activity for its own sake, love of creative activity, love of distinction, love of victory over others, love of the game, etc., undertake activities which tend to alter the given conditions themselves, to alter the structure and technique of economic society, to introduce new ways of doing things, and so to break the static equilibrium. This last type of men is small in number, but tremendously important. Schumpeter's theory of value rests solely in an analysis of the hedonic factors mentioned, conceived of as individual psychological magnitudes. I have discussed his theory of value in the chapter on marginal utility in this book, and would refer to that discussion here. He makes virtually no use of the value concept there developed in explaining the causation of dynamic change, but instead, as I have pointed out in that chapter, invents new concepts which do the work of the value concept, which he calls Kaufkraft, Kapital, and Credit, which do not rest on marginal utility, but rather on the activities of certain centers of economic power, particularly of banks. His picture of economic evolution is that of a conflict between these static and dynamic forces, between utility curves and the psychological factors of the energetic type, the former represented in a set of static price ratios, the latter in a set of dynamic powers, conceived of, not as sums of money, even though expressed in money terms, but as abstract power, which grows, not merely out of the individual psychologies of the entrepreneurs, but also, and primarily, out of the social influence centered in the banker. This power which the banker today supplies was in earlier periods supplied by the political power of the despot, and is distinctly a matter of social organization and social control, an over-individual social phenomenon, analogous to the social value which I have sought to put behind all prices, whether static or dynamic. The dynamic man needs power, either political or financial, to force the static men out of their accustomed ways of activity. They fear and resist him. He must coerce them. The contrast is thus sharply made between abstract price ratios, resting on individual feeling scales, and quantitative powers, measured in money, resting on a social basis. Between the factors underlying static prices and those underlying dynamic prices there is, thus, nothing in common. Statics and dynamics are concerned with fundamentally different phenomena. If my criticisms of the utility theory of value are sound, and if what has gone before in this chapter holds good, we must restate Schumpeter's contrast. The static tendencies do not rest on any peculiarities of the psychological stuff from which static values are derived. They rest rather in the universal tendencies of all values, whatever the psychological factors behind them, to come to an equilibrium. The reason that values, whether they be the values of new and novel things, or the values of old and familiar things, tend to come to an equilibrium is that gains come from equilibrating them. When some values are too low, and some are too high, the opportunities for speculative gain are evident. Arbitraging transactions, as between different places, time speculation, transferring labor and capital from one enterprise to another, increasing the supplies of some goods and reducing the supplies of other, changing land from wheat to corn, etc., etc., all these things are sources of gain, and they will be done, whatever the origin of the values involved. The new, dynamic enterprise, before it becomes actualized in concrete machinery, factory building, etc., and long before its income is actualized in money receipts from the goods it is destined to produce, becomes an object of value. The value is a future value, but it comes into the present as a discounted present worth. As such it functions like any other value, tending to attract in its own direction the land, labor, and capital necessary for its realization. It does not differ in its functioning from the present worths of future goods of familiar sorts. It tends, after a process of re-equilibration, which Schumpeter, with his theory of crises, has done much to elucidate, to come into equilibrium with the older, static values, becomes itself a static value. Indeed, from its inception, it comes under the static money measure. It enters at once into the scheme of static values and prices, even though it causes readjustment there. The pre-existing static values are themselves to be explained, not as growing out of individual feeling scales, but as growing out of a complex social psychology, in which some men and groups of men have vastly greater social power than others. The pre-existing static values are of the same stuff as the dynamic values. But this has already been made clear. The possibility of presenting an equilibrium picture of social forces, to the extent that those social forces submit themselves to the money measure, the possibility of applying the methods of static price theory wherever pecuniary concepts may be carried, does not exhaust the possibilities of the static notion, at least as a schematic device. There are many social values, particularly in the legal and moral sphere, which do not readily come under the money measure, and where such measurements as may be made in money terms seem obviously inadequate. Of these values, as of all values, however, the law of equilibration holds. All tend to come into adjustment of a sort that will allow the maximum of values to be realized. Something of the exactness of the static method has recently appeared in a decision by a famous jurist, confronted with the fact of the conflict of two legal principles. Most judges would go on the legal theory that there can be no conflict in the laws of a single sovereign. Of course, we have courses in conflicts of laws in our law schools, but the subjects treated in such courses relate to conflicts, say, between the laws of New York and the laws of New Jersey. When a judge is presented with a case of conflict between two laws of New York, he will commonly feel it to be his duty to remove the conflict by making distinctions, till the conflict is whittled away. Not a little bad law has thus originated. The law is absolute. It knows no exceptions. It does not obey the law of diminishing significance. Of course, de minimis non curat lex, but that means not that there is a delicate margin where the law ceases to apply, but merely that the law disregards trifles too insignificant to attract its attention at all. They are, in mathematical phrase, infinitesimals of the second order, discontinuous with the interests of magnitude great enough to attract the attention of the law. There is little room in such a legal theory for notions of the sort discussed in this chapter to find place. But a different theory of the law is implied, and partly expressed, in a recent decision by Mr. Justice Holmes. All rights tend to declare themselves absolute to their logical extreme. Yet all in fact are limited by the neighborhood of principles of policy which are other than those on which the particular right is founded, and which become strong enough to hold their own when a certain point is reached. The limits set to property by other public interests present themselves as a branch of what is called the police power of the state. The boundary at which the conflicting interests balance cannot be determined by any general formula in advance, but points along the line, or helping to establish it, are fixed by decisions that this or that concrete case falls on the nearer or farther side. It constantly is necessary to reconcile and adjust different constitutional principles, each of which would be entitled to possession of the disputed ground but for the presence of the others. Hudson County Water Company v. McCarter, 209 U.S. 349, 1908. Here we have a scheme very like that of static economic theory. The boundary at which the conflicting interests balance, the margin where the curves of diminishing value of the two legal principles intersect. A plurality of legal values, in marginal equilibrium. Lacking a tool of thought so convenient as money has proved for the economist, the jurist finds trouble in making his margins precise. He is dealing with quantities for which he has found no common measure. There is no standard or common measure of legal values. Hence, most lawyers content themselves with qualitative reasoning, seeking to avoid the necessity of quantitative weighing and comparison of the factors in their problem by making distinctions of kind. Mr. Justice Holmes recognizes the necessity and the existence of legal quantities and of making quantitative distinctions, i.e., distinctions of degree. He sees a generic essence common to the whole body of laws, such that marginal equilibria are possible and actual. So far we have a static system of laws. But the same writer, in a later decision, has said, and yet again the extent to which legislation may modify and restrict the uses of property consistently with the Constitution is not a question for pure abstract theory alone. Tradition and the habits of a community count for more than logic. Laurel Hill Cemetery v. San Francisco, 216 U.S. 358, 1910. As these traditions and habits of a community may change, so may the legal values change, and new equilibria need to be reached in a process of readjustment. But further, in this view, and in the view of the best students of jurisprudence in general, the legal values are not an insulated, self-contained system. In the sentence last quoted, Justice Holmes sees their root in a total social situation. And it is easy to show that economic values, in particular, are part of that social situation out of which legal values derive their power. Legal values enter into economic values. Economic values enter into legal values. And between legal values and economic values are marginal equilibria. There is a vast social system of values, legal, economic, moral, religious, etc., in constant dynamic change, but tending also to static equilibrium. Changes at any part of the system compel readjustments throughout. The process of equilibration is often slow, but slow or rapid, smooth or violent, it is in constant process. For the further elaboration of notions like these, I refer again to my social value. Here, as in the narrower economic sphere, we have men and institutions whose chief activity is concerned with the manipulation and control of these values, with effecting the readjustments and bringing about the reequilibrations. They have their appropriate tools and technology. Money and credit are merely part of a much wider system concerned with social control and social adjustment. To summarize, the problem of this chapter has been to harmonize statics and dynamics, the theory of wealth and the theory of prosperity, normal and transitional, and similar notions, commonly held to belong to different spheres, and to be incapable of reduction to common terms. A number of such contrasts have been passed in review, and numerous illustrations of the various types of contrast have been given. It is the contention of the present chapter that the most fundamental of these contrasts, and the one which gathers up the meaning of most of them, is that between the theory of value and the theory of price. The theory of value is dynamic, is concerned with the phenomena of prosperity and depression, is realistic enough to deal with transitions and readjustments. The theory of price is static, and rests in the notion of accomplished equilibrium, abstracting from the problems of friction and transition. The reconciliation comes from two angles. On the one hand, we have generalized price theory, showing that in large measure the phenomena with which value theory, theory of prosperity, dynamics, deal come under the money measure, are made static by discounting and by the application of accounting principles, that this tends to be more and more true as knowledge grows more accurate, that statics means especially quantitative, as opposed to merely qualitative, thinking. We have shown further that the static schema is applicable even where the money measure is inapplicable, and even beyond the economic sphere, as illustrated by a recent decision of Justice Holmes. The other angle of approach was to universalize value theory, dynamics, theory of prosperity, by showing that all prices, whether static or dynamic, have the same fundamental sort of explanation, that value is always a matter of social psychology, and never a matter of mere individual psychical magnitudes, or of material fact. This is not to deny that physical facts have their bearing in the scheme. A. They are among the objects of value, even though not the only objects, and B. Material facts, technological, physiographic, and biological, are the basis on which human nature rests, out of which it has developed, even though human culture including social values has increasingly emancipated itself from immediate dependence on them, and has acquired a partially independent movement of its own. The effort was not made to reduce mind and matter to common terms, but the case was rested in an irreducible dualism, and the causal influence of non-mental factors on the value scales themselves cannot be measured by the static scheme. The static scheme, assuming the value scales, gives a precise answer as to the influence of the quantities of physical objects on the marginal values. The significant fact about the values with which dynamics, theory of prosperity, etc., deal is that they are the values of immaterial social relationships and institutions, in large part, which are concerned with the problems of social adjustment and control, with affecting equilibria in the economic sphere, with overcoming the friction and effecting the transitions from which static theory abstracts. This is a phase of production quite as important as the physical activities of laborers or machines. It has its own technology, appropriate to its problems. In particular, money and credit are part of its tools. Since its problems are to control men's minds, it uses psychological forces. Where the mechanic uses a storage battery, charged with electricity, to move material things, the technologist of economic readjustment employs a dollar, charged with social value, which is power over the action of men. It is as a bearer of value, in form adapted to the problem, that is in highly saleable form, that the dollar functions. It is the psychological significance of the dollar, and not its physical qualities per se, that enables it to do its work. The physical weight in gold, which itself is an object of social value, is commonly the immediate basis of the value of the dollar today, but money may get its primary value from other sources than valuable bullion. Given this primary value, the dollar may get an enhancement in that value from the services which it performs in the social technology of adjustment. You've been listening to Value of Money by B. M. Anderson, the complete audiobook. Thank you for being with the winner's voice. If you found this valuable, don't forget to like, comment, and subscribe. Stay focused, keep growing, and think like a winner.